Don't be an emotional mess in this game, otherwise you'll end up with emotional returns. And emotional returns are not good returns. Warning, warning, warning. Ultra high growth stocks, like the ones we're talking about here today in this video, listen, they come with major volatility. Major volatility. Oh my gosh, what happened in the stock? There's really 2 steps to being a great boxer. You don't want to know what they are? Hit the other person as much as possible and get hit as little as possible. Make as much money as possible and live under your means. There is no shortage of money in the United States of America. You want to be a millionaire in the United States of America? Dude, you can be a millionaire in the United States of America. If you invest $200 a week and you receive 10% annual returns for 25 years, you would have $1.1 million after 25 years with a very modest amount of $200 a week. Look at this. If we just change it to a 14% return, just a few percentage points higher, suddenly you're at nearly $9 million. Life-changing money. We're talking this is millions and tens of millions of dollars up for grabs, right? Every once in a while, I have to just do a video where I have to just give advice out there and get everybody on the right track, prepare everybody for what's coming in this market, and some activity I'm seeing out there. And this is whether you're somebody with $1,000 to your name, you're just getting started in the market, right? Or whether you're somebody who's been running a portfolio for a long time, you got a $10 million portfolio. I'm going to give some advice out there that I hope everybody can take and really adapt this in the market moving forward, because otherwise I could see this kind of being a, let's call it a big issue for what we got to prepare for and things like that. So I hope you guys are going to really enjoy this discussion right at the beginning of this video. I think it's really needed out there, okay? After we get done going through that, I'm going to go ahead and react to Tom Lee. Tom Lee went on CNBC in the past 24 hours, shared his views on where the market's headed, why he believes that, and I want to share my opinions and perspectives from there. After we get done going through that, we're going to go ahead and talk some stocks. And I mean a lot of stocks in this one. We're going to probably talk about every single stock I own. We're going to also talk about some moves I'm seeing in some other stocks that are very interesting, some potential opportunities in the market, all that good stuff. So busy action-packed video. There's one thing and one thing only I need from you. If you could please just hit that thumbs up button. If you could just make that thumbs up button glow and hit that like button, that's all I need from you. And for every single person that's already done that, thank you. I thank you so much. Okay. So right off the bat here, okay, let me give some advice to everybody, whether you got a little money in your portfolio, whether you got a big dog portfolio, because I need to prepare everybody for what's coming in this market, some activity I'm seeing, okay? Listen. This is a sort of activity I'm seeing out there, right? This individual says Tesla stock's going to 4,300 by 2030, okay? Then we had some news like this come out here today. White House has issued warning and directs federal agencies to brace for mass employee firings. And people are like, oh, this means the crash is here. Like the whole economy is doomed. The whole market's going to crash now. All these sorts of things, right? And it's just so dramatic. It's just so dramatic. Like people are just so dramatic and so ridiculous. And the problem is, in the stock market, you've got to, if you want to really succeed in the stock market over the long term, when I say the long term, I mean over a 20, 30, 40 year span, and you want to really build massive wealth in the stock market, here's what you actually form your opinions on. Math. I know, not the sexiest subject, and I didn't like math in school either, but at the end of the day, it all comes back down to math. You cannot just throw opinions out based upon randomness. Somebody's saying Tesla stock's going to $4,300 by 2030. They're not making that judgment based upon math. Somebody says, oh, the stock market is going to crash 50%. Are they making that judgment based on math, or are they just throwing something out there? You could say, let me tell you how to actually look at this, okay? If you want to know where Tesla stock's headed over the next 4, 5, 6 years, run your numbers. What's revenue growth going to likely go up, and why is it going to go up that much or down? What's the net income going to likely do? What is a fair PE ratio for stock growing at that sort of category? And that's how you got to make your justification. And under no circumstance, regardless of what happens between now and 2030, like Tesla's not a $4,300 stock. On the flip side, you want to say the stock market needs to crash 50% right now. What are you basing that on? We're at a forward P right now of 23 on the stock market, right? The S&P 500. We have the biggest, strongest companies in that index growing at double-digit clips, top line and bottom line. So what is a fair forward PE? Is a fair forward PE really 12.5? When the most dominant companies that matter the most to the index are growing at double-digit top line, bottom line, that doesn't happen. That never happens. Point me out companies that grow double-digit revenue and net income year in and year out, earnings per share year in and year out, and trade at 12.5 P. You're not going to be able to because it doesn't exist. The only companies that trade at 12.5 P or 12 P or 11 P or whatever you think the market should be at, forward P, you know what type of companies trade there? Ones that have revenues in decline or having trouble even growing their business and have a lot of questions about if they'll even be around 3 years, 5 years, 7 years from now. So to say 50% crash, it's just, you're just completely just throwing stuff out there. And this is the issue we have in this market right now. And I don't want you guys to get caught up into this thought process because it's just so extremist is the way I would put it. Kind of like the political sides are so extreme now. That's what I'm talking about with the stock market. People are just ridiculous. They're just like fanboying to one side or the other, the bearish side, the bullish side. There's no let's actually run projections here. Let's actually think about the math. What would make sense in this situation? There's not a lot of intelligent discourse out there right now. It's just ridiculousness. And I think it's a lot of ridiculousness because the market's been pretty ridiculous the last few years. From the Rona crash to then all the stimulus money and the stock market goes booming to then a 2022 crash and everything that happened there to then the unbelievable bounce back in the stock market over the past really 3 years now at this point in time. It's just ridiculous. And so sometimes you got to understand that, listen, patience can pay. Patience can pay. You don't have to get into this mentality of every stock's going to 10x. This stock 10x is going to 10x. Oh, it's going to 10x the next 5 years. The market's going to crash 50%. You don't have to get in that mentality. You can look at it. You can say, hey, you know what? The market's trading at a forward P at 23. I think it deserves to be at a 20. I think we got 15% downside in the S&P 500 or whatever, right? Okay, that's a math decision. You say, okay, I think the stock's going to give me a compounded annual growth rate of 15% per year over the next 5 years. Okay, how are you getting there? Math. The revenues are going here, the net income's going here, the net income margin's going here, the P ratio that's fair for a company that's growing at these sorts of rates in this sort of space. Boom. That's how you do it intelligently. And that's how you actually have confidence. Otherwise, you're not going to have any confidence. There's no confidence. It's just ridiculousness, right? It would be like me saying the Las Vegas Raiders are going undefeated this season. Okay, could say that, but it's just a stupid thing to say. Just ridiculous. Okay, it's not based on any logic. It's just I'm emotional. And so when I see people, say all these different things, I'm like, oh my gosh, it's so sad. They're just emotional wrecks. They don't understand math. And I'm like, in order to be successful over the long term in the market, you better understand math. You don't understand math, you're going to be in a lot of trouble in this game. The way I would put it to you is kind of like this, right? This is how people are a lot of times in the stock market. They're just all over the place, right? If it's a scale, it's way on one side or the other side, okay? They're so either over the top bullish or so over the top bearish. It's just ridiculous, right? This is how you want to be in the stock market over time. Even keel. Okay, everybody wants to go risk on, the market's just climbing year after year after year, right? And the valuation's looking rich. Okay, be even keel. Look at it from a standpoint of, okay, market's probably a little bit ahead of itself and, there might be a price to pay for that in the next bit of time, and that's fine. On a perspective of everybody panicking, selling their stocks left and right, take a standpoint of yeah, this is bad right now. There's a lot of fear out there, but you know what? I'm going to take advantage. I'm going to choose to be bullish over the long term, and I'm going to buy stocks because I think this stock's a deal, this stock's a deal. And how do you know that stock's a deal? Is it because it went down 50%, 20%, 30%, 60%? No, that's not how you know it's a deal. You know how you know it's a deal? Math. You got to go back to the math and say, okay, revenue can probably go up this much per year under a bull case assumption, under a base case assumption, under a bear case. Boom, run all your numbers. And then you begin to understand, okay, this stock's a great deal, or you know what, this is a ripoff. That's how you play this game. Don't be an emotional mess in this game. Otherwise, you'll end up with emotional returns. And emotional returns are not good returns. They're not good returns. And so keep that in mind, folks. Be even keel in this game, and you're going to likely end up doing very, very well for yourself over the years. And you'll make a ton of money in the bull markets, and in the bear markets, you're not going to go under, which is half the battle. Like people forget, when you've been in a bull market, remember, we've been in a bull market now for basically 3 years, right? Obviously, we've had corrections along the road and pullbacks, things like that. But really, we're in a 3-year bull market now, okay? When you've been in a 3-year bull market, people forget about the bear markets. They forget bear markets exist. A market where, downtrends for 6 to 18 months straight. And every time you think it's coming back, it just ends up going lower. People forget about that. No different than when you've been in a bear market for a while. People start forgetting about the bull markets and how unbelievably powerful the bull markets are. Bull markets, by the way, are way more powerful mathematically than bear markets. People romanticize the bear markets. Oh, the great financial crisis. The indexes fell 50%. The Rona crash. Oh my gosh, S&P 500 went down like 34%, like in a snap of fingers, blah, blah, blah. They romanticize these time periods. What happened in 2022, right? The Great Depression, like they romanticize these time periods. But what they forget always is mathematically, the bull markets are so much more powerful. Like it's not even remotely close. Like you could see a chart looking at bear markets and how powerful they are versus a bull market. And it's not even in the same stratosphere. It's ridiculous. And so, because a bull market is like a never ending tidal wave that just, I shouldn't say never ending, but it's a tidal wave that just continues to dump ocean water on you again and again and again, year after year after year. Whereas a bear market is like one big wave that might hit you, and then that's it. Okay, so because bear markets usually last 6 to 18 months, and yeah, it's not fun to go through in the short term, but at the end of the day, like it's the best buying opportunities you get usually for the next 10, 20 years. Look at the great financial crisis, right? Like about as brutal of a bear market crash you could get. All the indexes went down 50% plus, right? Brutal. It was the best buying opportunity we've seen in stocks in the last, you have to go back all the way to the 1980s to see a buying opportunity that phenomenal. It was unbelievable, right? So be even in this game, guys. And you're gonna go pretty far for yourself, okay? Hope you guys enjoyed that little piece there, okay? All right, let's get into Tom Lee, then we'll do some stock talk.
But it's good to have you back. I know you love this trade. But what do you make of what Mr. Griffin had to say?
Well, I agree with him. We're in a period where there is a super cycle and exponential growth opportunities within AI. But it doesn't mean every company that has elevated valuation today deserves to actually have the capital, and that company may not even reinvest that capital properly to be a survivor. So I agree there is going to eventually be a shakeout, but I think valuations, strangely enough, are actually pretty reasonable today compared to 1998, because 1998 was that liftoff point before that final 18-month surge. And I'd say the best benchmark is Nvidia trades at 26 times forward earnings. Cisco at that same exact moment was at 60 times, and Cisco's PE peaked at 210 times forward earnings. So Nvidia to me is still a bargain at 26 times. It's cheaper than Costco and Walmart, which are close to 50 times forward earnings.
Sure, but all valuation.
You know what I like that Tom Lee did right there? Do you know what I absolutely love that he just did? He brought up math. Oh, it's brilliant. It's brilliant. He brought up math. Nvidia trades at a forward P of this. Here's what Cisco was trading at if you want to compare it back to in the tech bubble days, right? Here's Cisco's PE versus Costco versus Walmart, those sorts of things, right? It was beautiful. That's beautiful. And that's how you play this game. That's how you play this game. It's a math-based game, right? You got to try to get your emotions out of it as much as possible. Math matters.
Isn't created equal. And I'm not especially clear as to whether Mr. Griffin looks at the valuations of.
But let me push back against Tom Lee here, okay? Because he brings out an interesting point. He says, Nvidia's trading cheaper on a forward P basis than, let's say, Costco or Walmart. And obviously, Nvidia's growth rates blow those companies out of the water. Here's where I'll push back against Tom Lee, okay? He's right in regards to that. But the difference is Costco and Walmart no one's worried about like Costco and Walmart sales being in a bubble and like their revenue start to plummet in 27 or 28. That's not a realistic worry. about Costco or Walmart. But that is a realistic worry in regards to Nvidia. That does not mean it's going to happen, but we know these chip cycles last 3 to 5 years, and then there's a painful part of that chip cycle that comes after that. And so maybe this is totally different and like Nvidia just grows to the sky in 27, 28, 29. I doubt it as well. I doubt it. I doubt it happens. I think there's going to be a time period where Nvidia's revenue might even go negative, might start going down, right? What year that is, that's tough to predict, but I think that's a realistic possibility. And so that's why people are not willing to pay a great premium like they would, let's say, a Costco or Walmart, because Costco or Walmart is going to put up their numbers regardless. Nvidia, when you're in one of these big chip cycles and everybody and their grandma, all it would take is let's say we get a market decline, the economy gets hit. Let's say some of these AI programs aren't taking off as rapidly as you might have thought. Could these companies, the Metas and the Googles and all these companies, start pulling back on chip sales in 27, 28 from Nvidia? Sure. Could they start going with a more cost-effective option like AMD? Absolutely. That would all hurt Nvidia, right? And so, could more of these companies start doing more and more custom solutions like Amazon and Google are doing? Sure. Like, these are all things to factor in. So that's my pushback there in regards to, Nvidia and why people are not willing to pay a big forward P for a stock that has had insane growth the last few years. They believe, there's a realistic potential that fades in the next, let's call it 2 to 3 years.
But Nvidia, for example, and says, well, that looks a little out of hand. It reminds me of late 90s activity before the dot-com bust happened.
And that's why I said, for a long time now, what have I told you guys in regards to Nvidia? Nvidia's just stuck. It's stuck between about 125 and about a 200-ish level. And that's just what I think is going to continue to happen with that stock. When people are feeling great, it's going to bounce up to that $200 level. And when people are feeling down and out in regards to Nvidia, it's going to go down to about 125. And I think it's going to be there for years. Not a few months. And I've been saying this for a while now. I think I've been saying this for a year now at this point in time. The stock is just range bound. And the reason it can't, why can't Nvidia go $400 or $500? Because I don't believe people are going to think this chip cycle is going to continue to go up 20, 30, 40, 50%, 27, 28, 29. If people became confident in that, then you could say, okay, Nvidia could go $300, $400, $500. But outside of that, people just won't be willing to pay a big price for Nvidia.
As much as he looks at other names which have gone, parabolic and they're related to AI. And that's where he says, whoa. We're placing way too many bets on what might happen in the future. We think we know what's going to happen in the future as it relates to Nvidia and some of the other hyperscalers, but it's a whole host of other names that have literally ripped over the last 3 months, at least, that might bring investors a little bit of pause.
I think that's correct, Scott. There's a difference between a company being scarce in the public market. Let's say there's an IPO of a company and it's the only way for you to get exposure, versus that company being truly scarce to the ecosystem. So I do think investors have to discern, is this company going up a lot because this is the only name out of a possible bevy of private companies, or is this the company truly unique and one that is so scarce, I got to give it the N=1 valuation?
I think he looks also at a stat like JP Morgan Asset Management's Michael Sembalist brought to us today from his report. And he's good at what he does, okay? Quote, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November of 2022. Now, some would say, well, obviously, and all of that might be justified, but those are large numbers. Those are really large numbers that have carried a boatload of the weight of this move in the market since then.
Yeah, and that's a moment in time, Scott. Just to give some perspective, Nvidia is about 8% of the S&P 500 market cap weight, but it is also 7% of the earnings. So it's not necessarily distorting equity valuations. And in terms of what companies are excited about, if companies are saying that AI is something where they're actually allocating capital and many are, of course, are seeing productive gains, I think it's justified that would be what you'd expect to be the first wave of investment and spending is around directly into the ecosystem. But of course, over time, we'd expect that spending then to deliver productivity gains and other benefits. So that means if AI, and I'm comfortable with the idea it's a super cycle, we should see a broadening of the benefits and then also the broadening of opportunities over time. So it's probably a moment in time makes sense, but it should be broadening.
I mean, I look at a stock like Oracle, for example, only to pick it out because it's up more than 30% this month. Now, it obviously had the moment around earnings where it added such a tremendous amount of market cap after that event. I bring it up if only because it was initiated sell today at one firm on Wall Street, in part because they suggest that you've got some really aggressive assumptions that are coming with this stock. Now it's down 5% today because a lot of these names in what you would consider the momentum basket have rolled over a little bit. But the notion that the assumptions are so big that there's inherent risk in and of itself within that.
Scott, I think that there is going to be moments where it feels like we're possibly topping, and today is coming at a time when we have this Oracle report and stocks are generally soft. But number one, I think it's always really healthy to see corrections in a super cycle. But I do think it's really difficult for someone to actually ring the bell at the top. And in fact,
always.
Yeah, like if we look at Palantir or Tesla or Nvidia, I think that there have been, 25 bell rings at the top at every waypoint along the way. To me, I think the real test is going to be that we see a day where investors are convinced there's absolutely nothing that is wrong with the thesis and it's bulletproof, and yet stocks make announcements and they go down and companies actually have negative returns. I have not seen that yet. In fact, to me, it's reflexive to see that every time markets flatten out after posting gains, we have a lot of people declaring the top. To me, that's a really healthy sign that there is very little conviction about this bull market, and I do think it's healthy to actually see the skepticism. So I'm not opposed to seeing these reports, but it's healthy.
Do you think that equities are especially vulnerable here, as we wrote in our intro today, as BTIG suggests?
Before we go further here, the problem, to get back to Nvidia, chip sales, everything going on there, a big problem for somebody like Nvidia could be, let's say, I think my guess is, based upon mathematics, is I believe ChatGPT, in terms of the growth rates it's been showing, it's going to slow substantially in 26 and then slow even more in 27. That does not mean all of a sudden no one's going to use ChatGPT. No, it doesn't mean anything like that. It's just, if you look at the growth rates of ChatGPT in 2023, obviously off the charts. It's like a new thing, everybody is starting to download it, start to use it, right? 24, unbelievable. It starts to kind of reach more mass level, 25, even to another level, right? But I think as we go into 26, 27, the growth rates will start to slow substantially. Now, when those growth rates start to slow substantially, that's when investors are going to be like, wait a minute, the company's already valued at $500 billion. Are they going to try to value it at 600 trillion or 600 billion, 700 billion? I don't know if I'm willing to pay for that because the growth rates are now down to this number, right? Because people start running their projections and their math, these investors, and they start saying, you know what, I don't know. And then so maybe ChatGPT doesn't get as much funding, which then means they don't buy as many Nvidia chips, which could... Maybe this is already happening. You see an investment by Nvidia into OpenAI. That was a little strange, right? Okay, interesting. So maybe this is already a situation that's starting to play out behind closed doors. I'm not part of those OpenAI investors discussions or the Nvidia investor discussions that go on behind closed doors, but this is a potential that it's already starting in regards to that. Right?
They are the most since the April low. Do you feel the same? I should also mention it comes within the same context of commentary recently from the Fed chair, who didn't go out of his way when he answered the question about the equity markets to suggest it's wildly overvalued. But nonetheless, he did say that stocks are fairly highly valued. He could have said, I think they're fairly valued. He didn't. He said they're fairly highly valued when he answered that question. You put that into the mix too when you consider your answer.
Yes. Well, I have a lot of respect for Fed Chair Powell, but I don't remember the last time any FOMC member actually said stocks are attractively valued, because I don't think it's their job to comment on equity valuations that way.
Fair.
And if we think about where, again, market valuations are, I'd be very concerned if the most important stock like Nvidia was trading at a multiple that couldn't deliver returns. But it's the most important company in the world, 40% plus revenue growth. It's trading at 26 times forward earnings, which is hardly demanding for a company that makes a product that every single company in the world that is involved with AI actually needs. They can't replace it with anything else. So I don't think it's expensive. When you ask about April lows and valuation vulnerability, I think there's really two big differences. One is monetary policy was actually quite tight in April, and the risk was actually the Fed wouldn't even consider intervening, and yet markets managed to stage a 30% rally. Today we have a Fed that's not necessarily pounding the table that it's in a dovish cycle, but they've understood that they need to now use their hand to support employment. That's a sea change, actually, and as we know, ISM's been below 50 for 31 months. It's the longest stretch in the history of the ISM index. I think if the ISM breaks above 50, that's a recovery in confidence in capital spending. That would support a broadening of the economy, and I think that would be good for equities.
Well, speaking of Fed policy, and you stay with me, Tom, for a moment, Ken Griffin also gave his outlook today for what he thinks the Fed will do after cutting rates.
So the one other thing people haven't really, I don't think enough people are factoring in regards to Nvidia and where numbers go, but I think it's being factored in the market. That's why I think you're seeing Nvidia's forward P where it's at. I think it's really twofold. One is the reasons I spoke about before. The second part, why are people not bidding that stock up, right? Look at how great the numbers are. We know the numbers are going to remain great for at least the next year. Why are they not bidding it up? It's the most well-known stock in the market. Like, should be easy money, right? Like, why are people not bidding up? The other factor that I think the market knows is finally Nvidia's actually got competition. Nvidia's had no competition the last several years. The competition's here, and it's with AMD. You look at the 350 series AMD has, they're in the game now. And in the 400 series coming next year, serious competition now. So it's no longer just it's Nvidia's game and there's no one else there. They actually finally have a competitor in the market. And, if people aren't taking AMD serious, I would start taking AMD very serious, very quickly. Very serious, very quickly. Ask anybody that's underestimated AMD the last 10 years. Ask Intel. Ask everybody. Like, you do not underestimate Lisa Su and that team over at AMD. They get it done, and she's now, through the acquisitions they've done, through the developments the team has done there, they've got themselves in a good position to actually really battle it out with Nvidia over 26, 27, 28. So you could have a twofold kind of issue going on with Nvidia, and that's why people aren't willing to pay 50 forward P on that stock right now, like you might think they would, given the growth rates of that company. Because they're like, could have a slowdown chip cycle overall going, and then you got AMD finally becoming a serious competitor, and Nvidia hasn't had any competitors. That leads to margin pressures. You get margin pressures, then you could get earnings per share pressures, especially if your revenue is flatlining or going down. All of a sudden, now people are like, oh my gosh, it's a business in decline rather than it's a business growing revenues at 50, 60, 70% clips. Something important to understand there, okay? No, as far as some stocks go, let's talk some stocks, some opportunities, some things I'm seeing out there that are interesting. Celsius continues to roll the stock now up 99% so far this year. And when it comes to Celsius, the growth rates are insane. Like, this is a company that should be putting up triple-digit type growth rates for, honestly, at least the next probably 4 to 6 quarters. So, and then after that, we'll have to see where things even out at. There's a potential the company will probably, my guess is after the next 4 to 6 quarters where they come in with this triple digit revenue growth quarter in, quarter out, my guess is after that, this is a company that probably grows revenues, I would say in like the 8 to 15% range a year, right? A really good year for the company, the revenues grow about a 15% clip, a really bad year, 8%. But the thing is, in this next 4 to 6 quarters, we don't know, I'm pretty confident they're going to be growing triple digits, but how strong are triple digits? Because that's going to change the whole trajectory of where Celsius goes over the next 3-5 years. Because let's say they grow in revenues at 150% clip the next 4 to 6 quarters. Woo, if they're growing at like 105%, that's a big difference. Big difference. And then, if you're growing an 8 to 15% clip after that, that's going to be significant. I mean, we're talking about hundreds of millions of dollars of potential extra revenue or not. So the one thing I'm confident with Celsius is it's going to be like a triple digit revenue grower for, at least the next 4 to 6 quarters. And then after that, probably toning it down to like a 8 to 15% type range, somewhere in there roughly. If they really knock it out of the ballpark and then we could be talking about a company that grows like 20%, but I don't want to hold my breath on that. But we do know there's a lot of international expansion ahead, right? Estee Lauder is in the midst of their big turnaround. We all know that, right? So EL, I can't wait to see their numbers in 2026. They should start to grow revenue again in 26. And on top of that, they've obviously done all the cost-cutting measures. So what we should witness from Estee Lauder is revenue going up, simultaneously margins going up at a much faster clip, and earnings per share going up much faster because the cost profile of the business is going down, right? Revenue goes up. What's going to happen to your earnings per share and your margins? It's going to explode, right? So the math is going to be looking very fun for EL in 26, in my opinion, right? You might even start to see it, honestly, this next quarter they report. You might get an early glimpse this next quarter. And then it's going to get more fun. Winning Resorts continues to win. Like, my gosh. It's just a beast, right? Stock up now almost 54% this year, far outpacing the S&P 500, far outpacing the NASDAQ. And heck, I think Wynn's even beating Nvidia, which is incredible, right? But when it comes to Wynn Resorts, people really want in that stock because of the Macau optionality there. And a lot of folks are very confident that the math is going to be looking very good in Macau for the next few years. And so if that plays out the way it could play out here, like Wynn's profitability could increase rapidly over the next year or two. And then if you get lower interest rates along with that, then we're really talking, right? Fubo up to 420 here on Fubo here. Everybody's waiting for that deal to close. So exciting in regards to that. Adobe's just been kind of chilling out. Salesforce and Adobe are two stocks that right now, I love them. I just want to buy every share in sight of those two particular stocks right now. They're very attractive forward Ps right now. Based upon my projections on both those stocks, there's a lot of upside potential in both of them over the next 3 to 5 years. So I like them both, man, and I feel very comfortable in them. Amazon continues to be a buy. Listen, here's a simple thing in regards to Amazon. Amazon's been a buy every year since 1996. It's the same thing. Like, there's never not been a year where Amazon stock was a buy. Never. The peak of the tech bubble, it was a buy. You say, well, it went down 90% in the tech bubble. Oh my gosh, at the lows, it was down 90%. Still buy. You bought at the very peak of the tech bubble, you still made ridiculous sums of money. There's never been a day, a week, a month, or a year where Amazon stock was not a buy. And that continues to this day. It's still a buy. There will be a day when Amazon is no longer a buy. But it's not in this decade. Like, at the earliest, you're talking maybe 2030s or 2040s in regards to that. The e-commerce business is just going to continue to grow. The logistics business is just going to continue to grow. AWS is just going to continue to grow. The advertising business is just going to continue to grow. I was just watching the game on Prime last night. They're showing ads that you can literally just hit a button and then it goes to your phone and you can buy it right there. Like, it's just insane, man. And they continue to have, a phenomenal innovation team there. They've made some great acquisitions. And so that one's going to continue to, be a buy for a long, long time to go in the future. Now, if we look at big tech here today, Oracle continues to struggle. People don't believe really, I think, in a lot of those Oracle numbers they put up. Oracle stocks had a great year. I mean, look at this, up 70% this year. But look at the last, little bit of time here. Ever since that rocketing of the stock, right, after those earnings came out, I mean, the stock's down almost 17% since then. So even if we pull up like a 5-day here, on the past 5 days, Oracle stock's down 8.5%. That's a big down move. Like, how much is the S&P 500 down in the past 5 trading days? Let's take a peek at this. It's down 0.2%. 0.2% the S&P 500 is down, and Oracle's down, let's see, past 5 days, Oracle's down 8.5%. Oh no, the S&P 500 is down 0.16%. And yet Oracle's down 8.54%. So people, I think, have a lot of trust issues with Oracle numbers, and I think for good reason. You look at some of the stuff that came out with Oracle in the tech bubble, look into that sometime. Google it, okay? Go in Gemini. Go Gemini it someday, okay? Little fishy in regards to that. Shopify is up to 140. Their growth rates have been extraordinary. They've been growing at a very, very strong 20% plus, which has been extraordinary. AMD continues to kind of just be, AMD's kind of stuck in this 160 range right now. It seems like it goes, 155 to 165 right now. It's just stuck. My opinion is, as we get closer to the next quarter numbers, you could probably see momentum there. But when the next quarter numbers come out, wait to see the guide. The numbers are going to be extraordinary. AMD is going to report. I think they're going to report much stronger numbers than what analysts are expecting. But then the guidance, I think, is going to flip some people's flapjacks out there. And so AMD is on its way to 200 plus, right? As far as other than that in big tech, I don't really have too much else to comment on here. I mean, MU reported a great quarter, but MU stock is just a brutal stock. It's always been a brutal stock. They can report great numbers, but then people are always like, well, next quarter or next year, the numbers are going to start going down. They're always, at the end of the day, they're kind of like an Nvidia in that sense of like, they go through these boom and bust cycles and people are scared of them, kind of like the home builders, right? RH got hit today, almost pushing into the with a 1 in front of it. I think it should already be there. There's possibilities of a bunch of tariffs coming on furniture items. RH makes a lot of its products, I'd say a ton of their products outside the United States of America. And so how those tariffs hit RH is not going to be good, because RH, it's not like they've had great numbers as it is. And then if they have to deal with tariffs on top, it's not a good situation at all. So RH just continues to be a brutalized stock, and for good reason. They ruined their balance sheet. The company had a great balance sheet. The CEO decided to ruin it, and they deserve what they're getting. Like, make a really bad decision as a CEO like that. Like, you get what you get, and that is what it is. Other than that, everything else in housing kind of, even Enphase continues to falter. That stock's just been obliterated. That was one of the most hot stocks in the stock market a few years ago. I mean, I remember so many people were trying to talk me into buying Enphase stock back here in 2022, right? Because it was one of the few stocks that was actually doing good back then. Literally, Enphase was one of the few stocks was actually doing good back in that 2022 time frame. Like, the market bottom in 2022 around that October time frame, right? You go to November on Enphase. Enphase is a $300+ stock. I had so many people trying to get me in that stock. Oh, solar to the moon. I'm like, I don't think so. I think there's going to be a huge come down period. I thought Enphase was just really benefiting massively from a ton of people upgrading to solar, really in that 2020, 2021 and into 2022 timeframe. A lot of people moving. And it was just a hot market, and interest rates were insanely low. And I thought it was just kind of a temporary thing, and 100% it was a temporary thing since that time period. And Enphase stocks are down around 90%. 90%. And then you hear how anti-solar the president is. Whew, brutal. And so Enphase, man, that's another example I'm giving you guys here of you can't get caught up into these things when they're the hottest thing and people only see the upside, right? Because I'm telling you, in 2022, you had a stock like Meta trading under $100. I was buying that stock hand over fist, right? I could have easily deployed that money into Enphase at the time, because Enphase had the hype. Enphase had the stock that was being a beast. Enphase was loved. Everybody loved Enphase. Meta, no one liked it. Everybody hated that stock. They said I was crazy. I remember putting, I think I invested like over $70,000 in Meta in one trading day. People said I was crazy. What? No one likes that stock. It's the worst. Look at Zuckerberg. He's spending out, blah, 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 right? Oh my gosh, I made 7 figures plus on Meta stock. if I would have put all that money in Enphase, I would have a negative 90% return to show for it. That would have completely changed the public accounts returns. Like literally that one decision to go with a stock like Meta over a stock like Nvidia, Enphase, oh my gosh, I could have ruined the portfolio. Like think about that for a moment. I could have ruined the public account. But since I went with the right stock, the rest is history, right? So keep that in mind, folks, man. You play this game on the wrong side, ooh, it's brutal. Ooh, it's so brutal. Don't get, when these things are in a hype cycle, just understand, and everybody's talking about it, everybody loves it. Be careful, be very, very careful. My possible buys watch list here. I'm wondering if I should take a few stocks off this. Like Bucks. I like Bucks, but do I really want to own Starbucks? I don't know. I mean, they got so much competition with Luckin Coffee in China. Luckin looks like they want to expand in North America. There's a competition I've been talking about for the last 6, 7, 8 years on the main channel, which is Dutch Bros, right? I don't know if I really want to own Bucks. And their balance sheet isn't great. The thing, what could really make me want to buy Starbucks is if they actually had good food options. Like that's the one piece I've always thought was missing with Starbucks. If they could Brian Nickel, the CEO of that company, if he could get Starbucks to make a few good food items, like fresh, made in the store, not what they do now, like open the package and throw it in a microwave type thing. No. You actually you got just a few options of food items, but they're actually really legit good. I think that would be a game changer for Starbucks, but it seems like they don't want to go down that route. I think I'm going to delete I'll keep it on the possible buys watch list for now, but I kind of want to delete it. SoFi's still on there. Cava's still on there. Whirlpool's on there. Nike, Google, Amazon, Target, Cheesecake Factory, CRM. I might have just bought some CRM here today. Snowflake, Hershey's, Adobe, Wynn Resorts. LVMH is on there as well. That one's been interesting. Bath and Body Works. Okay, right off the top in this video, I want to go over my possible buys watch list, talk about some of the opportunities I see in the market, which ones could falter a lot more if this market continues to weaken, which ones are going to snap back the strongest if the market strengthens. So we'll get into all that at the top of this video. Looking forward to kind of sharing my perspectives on that. Okay, from there, I'm going to share with you what stock I sold here today, why I went ahead and did it. I think that's an important subject to cover. From there, we're going to discuss why market weakness is needed right now. It's needed actually if you're bullish on the market over the next several years. Actually, I'm going to explain why this kind of bearishness that's going on right now is needed. Okay, very important. I explain that in this video. Okay, from there's 3 little small clips I want to react to in this video here today. Why Jeffries, David Zarvos is still strongly bullish. Okay, that should be an interesting one to react to. Dan Niles spoke about AI. I always like to hear from Dan Niles. So he was on CNBC in the past 24 hours. So looking forward to hearing his perspective, kind of sharing my perspective and opinions based on that. And then from there, Doug Clinton, investors should stay in AI after recent spending announcements. Looking forward to kind of hearing his perspective on that. By the way, I appreciate everybody joining me as always. So much going on out there, folks. Always fun times. One thing only I need from you guys. If you could please just hit the like button on this video. If you could just make that thumbs up button glow, that's all I need from you. If that could be your payment, okay? Just please hit the thumbs up. That's all I ask. I hope you enjoy these videos I put out for you each day. And if you enjoy my videos, you want to see more, you can subscribe to the channel. It is free to do so. You can just hit that subscribe button, okay? So yeah, appreciate y'all for being here as always, okay? Alrighty, folks. Let's go over my possible buys watch list. Let's talk about some opportunities, and then we'll go from there in this video, okay? So here's the deal, all right? The weak is getting weaker. Essentially. What do I mean by that? I mean the weakest of the weak stocks, the ones that have already been struggling, are struggling even worse. And that's the scary thing. We've had a kind of a bullish market for the most part really since April, but some stocks have remained really weak. And when you're in a situation and you've got stocks that are really weak, even in a strong market, you got to understand if the market gets weak, those weaks are going to get even weaker, okay? As in, they're going to go down more essentially, okay? And so what I'm looking at is I'm looking at a stock like Cava, right? If you look at Cava, obviously a very exciting Mediterranean kind of Chipotle type flair, right? In regards to them in the restaurant business, quick serve restaurant business, that is, right? There's a stock that, yeah, it's got a very exciting long-term opportunity, but it trades at a very rich valuation. And this is a stock that's been incredibly weak. even despite the bull market. I mean, think about how much the market's up since, really like that springtime when we had all that drama in April, right? And look at Cava. It's just continued to remain weak, even when the market was bullish, right? And so you see a stock like that and it just is even weaker, right? Because I can tell you the stock market's not down 2.5% today, but Cava sure is down 2.5%, right? Bath and Body Works, another good example. This stock's been weak and it continues to just be even more weak, right? And these are the sorts of stocks that get hammered. Nike, good example, right? Obviously, Nike's still up a lot from the April lows when it was at $53 at that particular time, right? But Nike's still been a weak stock overall. And look at it here today. Whirlpool, another great example. Whirlpool's been such a weak stock. It's like embarrassingly weak. And this is one of those stocks, like if we talk about this S&P gets hit 10-15%, you could see a Whirlpool with a 5 in front of it. With a 5 in front of it, right? Which is, I mean, when was the last time Whirlpool had a 5 in front of it? Like, so in the 2009 great financial crisis, right? Whirlpool went down to $23 there. And right here, it went just under 50. This was in 2011, right? And outside of that, I mean, yeah. And so just understand, it wouldn't be unprecedented if the stock did actually go all the way down to these sorts of levels. That doesn't mean it's going to happen, right? But it wouldn't be like this has never happened before. Like Whirlpool could never go down there. It went down there. It went down to just under 50 in 2011. And then once again, the great financial crisis got all the way down to the low 20s. Oh my gosh, that's insane, right? So that's kind of the scary thing with some of these stocks like this, right? CRM continues to be weak, and this is another stock that's been, a weak stock in a strong market, but it's a great company. That's the thing. You got to differentiate the difference between a great company and a stock that just sucks right now. And Salesforce is one of the best companies in the world. I would put them for sure top 20 best company in the world, right? But their stock sucks right now, right? That does not mean the stock's going to suck over the next 5 years, but for right now, it's just a down and out, but it's a great buying opportunity for longs, right? And the good thing with Salesforce is I think the downside's very limited in a stock like Salesforce. Like worst case scenario, I see Salesforce maybe going 190, 200 if the market was to really get hit, right? That differs versus like a Whirlpool where it's like, dang, if the market really got hit, that stock could go $50, right? Or maybe even under $50. So you got to understand some of these stocks have more downside. A Nike, I think downside's really limited. I think worst case scenario, that one would go down to like high 50s maybe. I don't even think it would get down to those lows it was at back in April, which was like what, $53, $52, somewhere around there, right? A stock like Cava on the other hand, Cava could go down. I mean, if the market really got weak, I mean, Cava could go 35, 33, like almost 50% downside from here. If the market got really weak, that's like S&P goes down like 15%, NASDAQ goes down like 15, 20% or something like that, right? And so, something like a SoFi continues to show strength mainly because their growth rates are just ridiculous. So, any dip kind of ends up getting bought in that one, right? Target's another perfect example of what I've been talking about. The weak get weaker, right? Market gets hit a little bit and look at how weak this stock is, guys. And what does this smell like to me? Like, what is going on here with some of these stocks? You look at a Target, a Salesforce, a Whirlpool, a Nike, some of these stocks just getting hammered, right? Bath and Body Works. What do I actually think is going on? Even in Amazon, right? Amazon 216. Obviously, they got the $2.5 billion fine. Give me a break. That's like little money for Amazon, right? Just that. The best thing is that they just got that done with, right? But you know what this smells like to me, folks? I'm going to be honest with you guys. I think the market's actually seriously worried about recession. I'm going to be completely honest with you guys. I think the stock market is really concerned with recession. I really do. Seeing how weak some of these stocks are, I think that's what's going on out there. I think the stock market is very concerned with an end of this year and into maybe the front half of 2026 recession. And so I think maybe the market's positioning for that ahead of time, right? And then if that is a situation, let's just play out the scenario. Let's say that is a situation, right? And eventually, the problem is, I was going to say, then the government data confirms it, but gosh, I can't trust any of the government data now at this point in time. The way they're, like, it's always been manipulated, but it seems like now they're trying to take it up to even new levels of manipulation, right? So I don't even, like, even if we were in a confirmed recession at the end of this year going into next year, I don't even think the government would let you know of it. And it's sad. Like, I think that things have is so far gone now at this point in time that I don't even know if they would. But let's just say hypothetically we are in that situation, right? You got to remember these stocks will bottom way before the bottom of the recession, essentially. Okay. So you could get the news coming out of like, oh, the recession's here, it's going on right now, blah, blah, blah. And meanwhile, stocks are already moving up. And people are like, how are these stocks going up when all the bad news and everybody's talking about recession, blah, blah, blah. It's just the way the market works. It works in the future, right? So right now you're not getting any signs of confirmed recession, at least from the government data or whatever, right? You're getting like, oh, it's a slower economy, things like that. But just keep that in mind, folks. Like, stocks bottom way before you would think they would bottom, and they start going down way before you think they would go down. They're playing in the future, and that's always the way it is. But I'm just seeing too much weakness from so many of those sorts of stocks that you would think would be weak during a recession, like a Bath and Body Works, like a Nike, like a Whirlpool, like even a CRM to a certain extent, right? Like a Target, like a Starbucks, right? Even an Amazon, so something to kind of keep in mind there. But yeah, but then you look at something like a Wynn. A Wynn, you might think, oh, that would be a stock that would get hit hard if people were worried about recession. Not so fast. Here's the deal with Wynn. Wynn caters to the top 10% of income earners, top 10% of wealthy. So the viewpoint is when American consumers will continue to go to Wynn because they're still going to be rich, right? So it's not like they're going to be like, oh, I'm not going to Vegas because, whatever's in the news, the stock market's going down, they'll still go. But the other thing you got to understand about Wynn is, guess what? Okay, guess what? You want to know a little something like what? Like, look at how strong this stock has been. Look at how strong this stock has been this year. Up 50% this year, right? Blowing away, like just obliterating the S&P 500. Like, it's not even close. You know what? Let's pull up Nvidia. We even pull up the big dog. Look at this. Wynn stock is smashing Nvidia. Do you know how special you got to be to smash Nvidia? Nvidia is at a 28% gain this year. Winning Resorts is at a 50% gain. Get out of my face, Nvidia. You're nothing. It's insane. S&P 500 up 12%. We're talking, this is like, what, a 4x performance over the S&P 500 for Wynn? But here's the thing with Wynn, okay? Outside of what we just spoke about with top-end consumer. Listen, Wynn has 3 properties in China. Now, there's a viewpoint that the Chinese economy is actually strengthening right now. And they already went through their big recession really back in 23, 24, and even started a little bit in 22. And there's a viewpoint that the Chinese economy is actually starting to heat up. If the Chinese economy is starting to really heat up, that means very good things for, guess what? Wynn Resorts. The Chinese stocks are starting. Have you seen the Chinese stocks performance? Look at Alibaba. Look at Alibaba, the big dog. Let's pull up Baba. You want to pull up Baba? We'll pull it up right now, okay? I think I had this Dunkin' Donut coffee. It got me a little too crazy today, okay? And plus, I love seeing stocks go down. I mean, it was like so exciting to me. I don't know, like if you're a beginner in the market, you're like, no, I need stocks to go up every day. No. You want stocks down. Stocks down mean you make so much more money long term. I mean, you get great buying opportunities, man. This is like, I get more nervous, worried when stocks just go up every day. I love it when we get some red. I'm like, let's go, baby. Look at Baba, 104%. 104% this year. It's smashing even Wynn. Listen, there's a viewpoint that if you played out what happened in the great financial crisis, the Chinese economy was getting hit before the U.S. stock market really got hit and like everybody was freaking out about the U.S. economy. Chinese economy got hit first. Then the Chinese economy was actually coming out and actually looking really good. Even when the U.S. economy was in the great financial crisis. So not all countries go through a traumatic experience at the same time. So there's a potential, like the people are worried about the U.S. economy is going off the rails, right? And that's debatable, but it's a serious debate you could have. But there's a view that the Chinese economy is heating up. And stock prices are going up, real estate's going up. The businesses are going to be doing better and better and are doing better and better. That's a viewpoint at least, right? And if that's true, then Wynn Resorts is going to be putting up some amazing numbers. And remember, Wynn in Macau is much more important than Wynn in Vegas in the Boston, because they have a property in Boston which they operate, right, as little money stuff, okay? Like they make money from that property, little money, okay? The Vegas properties make money, but compared to what they could make in Macau, little money. Macau's the big money. If you know the gambling numbers in regards to Macau versus Vegas, there's a night and day difference. So there's a potential here that Wynn could just stay as a great stock regardless of what's going on in the market. Keep that in mind, folks. Keep that in mind. I call it Winning Resorts for a reason, right? And they've had some tough and also believe me, like, you know what the other factor is? If there's a belief that the economy is going to get worse, if that's a belief, what's the Fed going to do? They're going to keep lowering rates. And if they keep lowering rates and then simultaneously you have people worried about recession, so there's really going to be not much for inflation, then you're going to see yields fall across the board, which means Wynn can take on debt for cheaper. They can refinance debt for cheaper. Means they make even more profits in the future, which is a phenomenal thing for Wynn, right? And remember, Wynn has a land bank that if they want to, let's say rates go down a lot over the next year and they want to, say, build a new property, they got a great piece of real estate right in Vegas. If they got a great piece of real estate right across from the Wynn in Encore, they own that land. They could build a phenomenal property right there if they choose to do so. Let's say rates go down a lot over the next year. Why not build a new property in Vegas? After all, these properties take, guess how long? 3 to 4 years. So even if you make an announcement like that and you're in recession, who cares? The property wouldn't open till like 2030. I hope we're not in recession still in 2030 if that was a situation, right? Otherwise, we're all doomed in the United States forever, right? So that's something to kind of keep in mind there. Adobe actually is relatively strong here today. RH has been hit so much that maybe they just don't want to get hit anymore. But, you know, the moral of the story is here. I love it, man. I love it. I love it. I love it. I love it. Look at Bath & Body Works down 3.3% here today. Bath & Body Works just so weak. Look at that stock down 31% this year. I like it, man. That's a name I actually feel comfortable regardless of the economy. Like, good economy, Bath & Body Works still going to sell a lot of soaps and candles. You know, bad economy, like, people still going to, like, it's not like people are like, oh, I'm not going to go buy my soaps and candles from Bath & Body Works. Like, they're still going to put up their numbers. They're still going to do their thing, right? I'm not, you know, if anything, I'll make an argument that people might get more Christmas gifts for their significant others there and things like that, right? And stocking stuffers and all that sort of stuff. So Bath & Body Works is actually intriguing. And they got the one thing I don't like about Bath & Body Works, the one thing I don't like is their debt load on that company. But guess what? Let's play this out a little bit. If this economy gets weaker, if rates go down, right? If that's a scenario, Bath & Body Works can easily refinance debt for much cheaper rates, makes them even more profitable in the future. That interest expense could go down. Something else to keep in mind there in regards to a stock like Bath & Body Works. So, yeah, a lot of factors at play. Okay, next subject up here is what stock did I go ahead and sell here today, and why did I go ahead and do it? Okay, now there's a very rare move. I made it in my Patreon portfolio today, and that is I decided to sell some of my biggest position in the Patreon portfolio, Palantir. I sold 15 shares in the Patreon portfolio. Those were filled at $181.19. I was about $2,700 in proceeds from that sell there. I did not sell out of the position completely, but I did sell it overall. And so Palantir is now down to my second biggest position in the Patreon portfolio. Patreon portfolio, by the way, is a $55,000 portfolio. And so yeah, so we're sitting on 30 shares now at this point in time. I did buy a couple other stocks with that money, and then I left a little bit in cash. But the Patreon portfolio is looking amazing, absolutely amazing, that portfolio. So AMD is now the largest position. Before, obviously, the sell here today, Palantir was the biggest. So Palantir is still the second biggest position, so it still matters significantly to the Patreon portfolio overall. Now, as far as profits taken so far in 2025 for the Patreon portfolio, I am at $3,799 of profits taken in that portfolio, which is a pretty decent amount considering it's only a 50-something thousand dollar portfolio, right? I had took $383 on Toll Brother put options earlier in the year, $77 profit on some EL shares. Palantir took $2,515 profit, and then Tesla, my I took $823 of profits. Now, in terms of those profits, those are kind of small potatoes compared to the public account. Look at the public account in 2025. You gotta be flipping my flapjacks. $668,000 of profits taken so far in 2025 in the public account. That's the big dog. Oh my gosh. Like, what a year it's been. Not one L taken in the public account the whole year so far. Like, and the greatest thing is I've been able to take so many profits from put positions in the public account and long positions. Like, legendary, man. Legendary. Like, what else can I say? Like, what a year. What a year. Sometimes you got that, right? Like, 2022 was a year that sliced and diced me, man. I got obliterated. It was tough. And sometimes that was a year that just seemed like everything that could go wrong was going wrong from the portfolios. And then you get a year like this year and it just seems like literally everything is just going perfect. Like, it's like the put positions are printing, the long positions, like, it's just like can do no wrong, right? So sometimes you get that sort of situation. Now, as far as Palantir, why did I sell those shares here today? I mean, it doesn't give me an attractive ROI over the long term here. Okay. And when I say long term, I'm talking over the next 4 or 5 years. As far as Palantir goes here, I don't know why my numbers are messed up on this particular one, but basically, based upon my numbers I have here, as far as Palantir goes, like, maybe a 2% to 6% CAGR I get in Palantir over the coming years. Like, it's just not attractive under my base case. And so given that situation, but who knows, like Palantir, if the market gets hot again, could go 200, 250. Like, that's the thing. Like, there's no telling if we've already topped on Palantir. And I never try to worry about I'm going to get the exact top on Palantir. This is the top. Like, at the end of the day, I just look at it pretty simple. Like, is there a lot of money to be made in the stock over the next 4 or 5 years or not? In Palantir, I just don't think so. I do not think there's a lot of money to be made in the stock over the next 4 or 5 years. Over the next 4 or 5 weeks, who knows? Market gets hot again, like Palantir goes risk on, all of a sudden the stock's at 202, right? But as soon as the market starts to get a glimpse of like growth rates are decelerating, the stock's gonna get crushed. And the retail investor community will not be able to save it at that particular time. The market cap's too big at this point in time. So you'll see the stock go down 30, 40, 50%, and it'll stay down for a while when that happens, right? And then eventually they'll have to kind of bottom out those numbers. And that takes a while. Like, sometimes if you have decelerating growth rates, let's say they top here at 50%, right? And then people have become confident, like the growth rates are going to start going down. So then the next quarter is like 47% growth. Then it's like 44. Then it's like 40, right? Then it's like 37. Like, that's a cycle to go through that's kind of painful until people are confident you bottom out that cycle, right? And then you can go up on the other side, maybe accelerate growth, or maybe just consistently grow at a number. But that's a whole process you got to work through, and it's painful. It's a painful process, right? So just something to kind of keep in mind there. Now, if you want to see the stocks I'm buying and selling each week in the Patreon, today's the last day to get in this particular tier that's $33 a month. This is where you get to see all the stocks I'm buying and selling each week, including the stocks I bought today, right, in that portfolio. Plus, you get access to that Discord chat in there. I'll put that as a pinned comment down there today. Tomorrow, that tier is going to $39. So if you want to get in for the grandfathered price of $33 a month, you have way less than 24 hours basically to get in there, and that will be the pinned comment down there. And for everybody that's joined before the price goes up, you're grandfathered at the 33. It won't go up for you. It's only going to go up for people that join Friday and after, essentially. So keep that in mind. Now, why do we need this weakness in the market? Okay, listen, we need this weakness in the market. Look at the Shiller P. I mean, the Shiller P is not my favorite metric at all. I don't think it's even close to the best metric you can look at in the stock market, because taking the last 10 years into account, inflation adjusted, I don't love the metric, okay? But a lot of people do. And at the end of the day, you push a 40 Shiller PE, it's extremely high, right? It makes people feel very uncomfortable. We got to get that baby down. Then you look at the forward P, right? Forward P is something I look at a lot more. I think it's way more important than something like a Shiller PE or even the Buffett indicator, okay? And we look at the forward P on the stock market, it's rich. It's 23 right now, right? Which is, where we were right here, kind of in the late 2024 timeframe, right? We were also right around here when the market topped in 2021. Now, we were higher back in Rona, but I don't think that really counts. That was a freak situation there, right? We're higher than we were in this peak here in 2015, where we actually had some drama. And so at the end of the day, like this is a pretty dang high forward P. I would love to see that forward P come down a bit, right? I mean, you look at it here, we got all the way down to 19, in that particular situation. So the bottom line is we could use some weakness in the market. It's actually the best thing for the market. If you want to be bullish on the market for the next 3 years, I would hope the next 3 months are bearish. As simple as that. Let's react to some Wall Streeters.
Strategist at Jefferies. He is on the list of 11 potential candidates to be Fed chair. Just to see Jerome Powell. He is the most dressed up guest we've ever had here at the NASDAQ. It is great to see you, David.
Look at this man. He's going to be the chairman of the Fed. Listen, Trump probably just picks people based upon the way they look. And like, I feel like if Trump saw this guy, like he'd just be like, yeah, he's going to be the Fed chair. Like,
here at NASDAQ. It is great to see you, David.
It's great to be here.
Usually you're in a hoodie.
I know.
Exactly.
It's like a full transformation.
all you got to do is show Trump this picture. Literally, just screenshot it, send it to Trump, and Trump be like, that's the next guy. Make him the next Fed president. That's our guy right there.
But I want to talk to you about, first of all, Chair Powell and what he said yesterday in terms of the stock market, because you are very bullish. And what he said yesterday was that stocks are fairly highly valued.
Yeah.
Why is he wrong in your view? Or is he not?
Valuation is one of those things. It's like tasting wine, right? Everybody's got different views. I think there's a lot of ways you can look at the equity market and say we have an incredible earnings outlook ahead of us. We've got an investment horizon that looks incredible based on a lot of the changes that have taken place in the policies, whether it's dereg, whether it's the one big beautiful bill, whether it's tariffs forcing some people to the table to invest more back in the United States, which is a huge
disagree with him right off the bat. Okay, listen. Companies are scared to invest right now. The only companies that are really investing heavily right now into their businesses are the biggest of the big tech companies, right? And that's really it. The mom and pop business, the mid-sized businesses, even most large companies are actually scared to invest in any sort of long-term horizon because they are very uncertain right now. They don't really know what the deal is with tariffs. They don't really know where the Fed's headed. They don't really know where the economy's headed. And they don't know what Trump's going to say next or doesn't say. And so I look at it right now, and from my standpoint, I'm looking at companies that are a little scared to invest unless it's the biggest of the big techs. And they're like, we're building data centers because we're going to be the AI future, right? So Meta, Google, those, Oracle, blah, blah, blah. Those companies aren't scared to invest right now. But those are a very select few. You go beneath that, and it's like, I'm looking at companies that, if anything, they're tightening their budgets right now. They're scared to invest because they're like, I'm not really sure what's going on. We're just trying to operate our business the best way we can right now, but we're not going to play it safe. We're not going to invest heavily at all right now. So the only space I really see big investment is the very top with the big chip companies and all those companies that are buying all those chips right now. So there's big investments going on in regards to TSMC and Intel, right? And then obviously with Nvidia chips, AMD, and all those companies that are using that at the very top of the market. But we're talking, that's like 10, 20 companies, right? At the very top. Outside of that, you got to understand, like, the whole economy is not just those 10 or 20 companies. It's a lot. The rest is a lot bigger than that.
That I don't think a lot of the models at the Fed are taking into account. So I think there's a lot of reasons to be confident. And one of the reasons, that we've got a headwind a little bit to it, particularly in interest rate sensitive sectors and in the labor market, is that I think monetary policy is just way too restrictive. So I've been saying that for a while. I've been saying it since before the election, and I'm still sticking with it. Happy to see that they kind of have turned a little bit, but we've got a lot more to go.
The turn sounds very cautious, though. I mean,
do you guys see what's going on here? I hope you see what's going on here. The man wants the job. The man wants the job. I hope you see what's going on here, right? So this is one of those things. He's like, maybe Trump's going to see this clip. So let me make sure, like, one of these 4,691 views might end up being Trump, right? He's like, let me make sure I'm telling him what he wants to hear, right? Because we know Trump's going to be extremely influential in regards to who gets picked this next, big dog at the Fed. And so he's basically saying, oh, we got a long way to go. That's basically a little dog call there of like, put me in, coach. Like, I'll get these rates way down, right? As simple as that. But the weird thing is how are you going to be so strongly bullish, but then also want rates to go down a ton? What? That's a little weird, huh?
When they call it a risk management technique to cut rates now, it doesn't sound like there's another cut firmly in the books or another, even after the next meeting. I mean, it just doesn't sound like the path is clear there.
Well, look, Jay's got 5 meetings left. He's really not our forward guidance. Our forward guidance is going to be the folks, one of those persons from the 11 that you mentioned, along with whoever takes the Adriana Kugler seat in January, which may be Stephen. He's there for 4 months now. And then the drivers of Mickey Bowman and Chris Waller. So you're going to have 4 folks on the committee, and possibly 5, depending on what happens with Lisa Cook, that I think are going to come at this very differently. They're going to come at it with a supply side style view, with a view that is very different than the groupthink that has engulfed this Fed for a very long time, but has, I think, become, unfortunately, more political as of late.
Yeah, more political as of late. Yeah, that was interesting, man. Like, if you know what's going on, if you know what just happened there, okay? Dan Niles next up here.
Investment management. Dan.
That was a crack up.
You've been doing this a while. Is there any part of you that worries that all of this, dare I call it, hopium around the AI spend is a little overdone?
Oh, yeah, it's definitely overdone. And, I think Bill Gates a long time ago said it best, which is technology is generally overhyped in the short term and it's underhyped in the long term. And the best example I can give you is back from the internet. And from
100% true. And if you saw my breadcrumbs post in the private stock group last night that I posted very late, you know exactly what I was talking about.
Days, you may remember Cisco was the most valuable company on the planet. It was the Nvidia of its day, as it was putting in the plumbing to enable this new thing at the time called the internet. And I remember the CEO at the time forecasting that he thought he could grow revenues at 30 to 50% per year sustainably because of that. And then a couple of years later, his revenues declined. And then the year after that, his revenues declined. So you have to remember these CEOs, especially if they're in the businesses they're all highly optimistic. That's how you get to be the CEOs. You have this vision out in the future. But don't mistake fantastical growth forecasts as, this is what is going to happen, especially the further out you go.
So this is where age and experience, I think, does matter a little bit, because I know what you're talking about. John Chambers, who I interviewed many, many times at Cisco, and they were the biggest company in the world at the time. And I was there when the internet was being created. A lot of those companies went bust, and a lot of them went on to become the powerhouses that they might still be today. But Dan, I think you would agree with this, is that we have CEOs now, and I'm not going to name any companies now. I'm not out to get anyone, okay? But we have companies now that are saying things that they have no power over. In other words, I can talk about all the data centers I want, while the utility companies are sitting back going, oh, that's interesting, because we're the ones that actually make the power, and we're not sure how we're going to do it.
Yeah, but to me, that's not even the relevant question. The relevant question is, are companies that are deploying AI generating revenues from it? So you can look at the MIT study that said, now remember, we're almost 3 years since we all heard about this thing called ChatGPT. And the MIT study that came out earlier this month said that 95% of corporations deploying AI are seeing 0% return. Bain came out with a study yesterday that said we're going to be about $800 billion short in terms of revenues to fund this AI spend by 2030. And so you can look at statements like that, or a very simple one your viewers can relate to is, if you remember late last year, Salesforce was talking about agentic AI, and they were the poster child for agentic AI, and their stock was at an all-time record high. In August, the stock was at a 52-week low because this stuff's not getting deployed at the rate that the CEO there thought. So the revenues that you're generating from this, just like with the internet, right? You built out all this fiber, you didn't generate the revenues you needed, and then you had to go through a really brutal digestion phase after that. And I don't want to make any mistake. I am bullish right now for one simple reason. It has nothing to do with AI. It has to do with the fact that the Fed is cutting rates. And historically, when that happens and they're spiking the punch bowl, as I wrote about this last Sunday, the market's going to go up. But I said you want to be invested in a broad market of stocks, not just 7 names associated with AI. And that'll take the AI names up with them. But I think in 2026, you're going to figure out that you don't have 20 companies that are going to win in AI, and people won't fund 20 companies that are all burning cash.
Yeah, but to push back against Dan Niles there, so I agree in terms of like, are these companies going to get the payback? Even OpenAI, like I have questions like if they're going to get all the payback on all this, right? But you got to remember, like I feel like for a lot of these companies, AI is not just the everything. AI is like a component of their business. So even if I look at like Meta, right? Like Meta is going to make so much money probably directly from AI, but also indirectly. And they're already making a lot of money from that, right? I look at a lot of small software companies that are going to have AI be a component of their business, but it's not the whole business. It's just a component of the business, right? Even a company like Salesforce, they're going to make a lot of money from AI over the next 5-10 years, but it's not like an AI-related product is the whole business model or something. Adobe, I think Adobe can be a beneficiary of AI, but it's not like Adobe, the whole company is just like all just an AI product or something like that. So I feel like for most of these companies, AI is going to be a component of the business. It's not going to be the whole thing. And that maybe differs from the internet companies where those were just like brand new companies trying to make it on the internet and a lot went under. This is like a lot of established real companies that are building businesses that have an AI component on them, right? And that's very different than the internet bubble when it was like brand new companies, new executives of these companies trying to run the business and they're getting this capital and they're trying to invest in it and we don't know. Like a lot of those internet companies that went under, almost all of them, they didn't even have a core business model. Like you look at all these companies spending all these fortunes of money, Google, Meta, go through the whole list of them. They have massive core businesses, the biggest, most profitable, best core businesses we've ever seen in history, right? And now they're investing heavily for a new component of their business, which is AI-related products and services, right? So something to keep in mind here. Next up.
Alpha founder and CEO. It's good to see you.
You too.
As I said, I mean, it was sort of right there in front of your face as to why there's so much excitement about what's happening here. Is that how we should take it, as a reminder to stay here as an investor?
I think it is a reminder. And we've got all this stuff on X. If you spend 2 minutes on X looking at anybody with a finance account, it feels like everybody wants to call the top. Valuations are frothy.
Hey, do you guys follow me on X? If you don't follow me on X and you use X, I always have it linked in the description of all my videos, okay? And my X has been booming.
See these deals where Nvidia is investing in ostensibly one of their biggest customers, and they say, we've seen this playbook before. This happened in the dot-com era. It has to be over. I think that's the wrong perspective, though. I think it is a reminder that this is the biggest infrastructure build ever. And these companies like Nvidia, like OpenAI, they're dealing with such big dollar numbers. It doesn't move the needle if they invest in some small company. Nvidia needs to play big. The only way they can play big with a model builder is to invest in OpenAI.
But I feel like as an investor, we all need to take a tremendous leap of faith, maybe in ways that we haven't had to take in 25 years, when we're assuming that these big numbers are legit, that the return on the big numbers is going to happen, and we have to put all our faith in a kind of market where we're used to putting our faith for a 6 to 9 month time frame, right? We make bets ahead on what's going to happen in the future in the stock market.
Yeah.
Now we're talking about having to do that in years. Is that right? You feel that way?
I think that's right, and it is uncomfortable. I won't say it's not uncomfortable. I think it's even uncomfortable for me as someone who's spent my life in tech. But I think we kind of see the writing on the wall, and I've said this before. I think that this AI spend boom, it will culminate in a bubble bigger than the dot-com era. I don't think we're there yet. I think we still have 2 to 4 more years. We've talked about that before here on this show. I still think that's the right time span to think about how aggressive these numbers are going to get. And on top of that, you look at what the mega cap companies are doing. That is one thing that's different in this era versus the dot-com era, is that the biggest companies in the world they're all in. They're spending hundreds of billions of dollars of free cash flow they're generating on these infrastructure builds. So I think that's the thing that's different, where they're going to continue to put this money to work, and I think it might last longer than people think.
What about the less profitable to no profitable names that have surged a lot in the last few months? That make you nervous, cautious? Is it much ado about nothing? What do you think?
They make me even more nervous, and I'll tell you what we've done at Intelligent Alpha. We use AI to do our stock picking, and our models, I think, have actually...
We use AI to do our stock picking. That's about enough of that guy. Let me ask you a question. What do all these stocks have in common? These stocks over the past 10 years, Nvidia has gone up 31,000%. AMD's gone up 6,900%. Shopify 5,300%. ServiceNow up 1,100%. Amazon 924%. Meta 859%. And Google McDougal up 831% over the past 10 years. What do all those stocks have in common? They've all been unbelievable growth companies, with those companies all growing their revenues pretty much year in and year out at a strong double-digit clip. And what does it end up adding up to? A whole lot of money made. Look at this stock here. Went from 12% growth to 16%, 19%, 20%, 27%, 30%, 36%, 39%, 48%. With a stock like that, what do you think happened to its stock price? Well, let me show you the stock. You might know it. It's called Palantir. It was a life changer, right? Folks like myself made over 2,000% in gains in the stock over the past few years because it had the ultra high growth, right? If you had a small amount of money, like a little bit of money, and you invest in a Palantir, now you're doing well for yourself. If you were doing well for yourself and you invested into Palantir, you're now rich. And if you were rich and you invested into Palantir stock, you're now super rich. It's an absolute game changer in a portfolio. So here today, I'm going to go through 5 ultra high growth stocks to buy. I'm also going to give you guys an honorable mention in this video here today. These stocks I'm going to be sharing with you are growing at like 20% plus type clips, just so you know, like these are ultra high growth stocks, okay? I appreciate everybody for joining me for this one. Hope you get a lot of value out of it. One thing only I need from you guys, if you could please just hit the thumbs up button on this video. If you could just press the like button, that is all I need from you. For everybody that's already done that, and I didn't even need to ask for that, I appreciate you guys in the biggest way, okay? Additionally, if you want to be subscribed to my channel, you can certainly subscribe. You'll see more of my videos in the future. If you enjoy stuff like this, I think you'll enjoy a whole lot more of my videos down the road here, okay? Also, I want to let you guys know the Patreon tier, my Patreon tier, which you get access to see the stocks I'm buying and selling each week, plus you get access to the Discord chat that's in that particular Patreon, okay? That tier on Friday is going to be moving to $39 a month. So if you want to get in that tier, I would do so right now. I'll put that as a pinned comment down there. It is $33 right now. We've had it at that price for quite some time. We will be moving it to $39. Now, for everybody that gets in before it moves to $39 and everybody that's already in that particular tier, the price will not be moving up for you. You will be grandfathered at $33. So if you're paying $33, it's not like we're going up to $39. No. This will only be for people that join basically Friday and after, okay? So if you want to in that tier, that is going to be the pinned comment down there. Enjoy that, okay? Alrighty, guys, let me give a big warning out there before we go any further. Warning. Ultra high growth stocks, like the ones we're talking about here today in this video, listen, they come with major volatility, and you have to be mentally prepared for that. If you are not mentally prepared, you cannot own ultra high growth stocks. You will get thrown out of these. No different than an ant that's on this waterfall right now in my backyard, right? If I had an ant up there and it got in that waterfall, it's going to get thrown right down, right? That's you if you're not mentally prepared for a lot of volatility. Every single high growth company I've ever seen in my 17 years in the stock market, every single one went through dramatic corrections, crashes, time periods when it was like, oh my gosh, what happened in the stock? Every single one. If you are not mentally prepared for that, You cannot own these stocks. Warning number 2 I got to give out there, okay, is all of these stocks generally have higher PEs than an average stock. They're also going to have higher price to sales ratios than an average stock out there, okay? If you don't know what a PE ratio is and a price to sales ratio, Google it, okay? Listen, that's fine with these sorts of companies because they have the sort of growth that can hopefully get these companies to the finish line where you might be buying it today and think it's expensive, but actually in 5 years from now, it was actually a cheap price because essentially they grow into that valuation over time. And so the way I'll put it to you like this, right? A normal average stock in the stock market, it's a Honda Civic. There's nothing wrong with the Honda Civic. It's going to get you point A to point B, and it's perfectly fine. And you know what it is? It's pretty cheap. That's an average stock. That's a normal stock in the stock market. But then you have the ultra high growth stocks. The ultra high growth stocks are an F1 car. An F1 car can go around a corner at 100 miles per hour, right? Unbelievable. Those cars are meant to do very, very special things. And they get you more than just point A to point B, right? A Honda Civic, you try to take it around a corner at 100, if it even goes 100, and you're going to be saying hi to my ancestors, okay? It's not going to quite work out for you. So you cannot expect a Honda Civic to do the things an F1 car can do. Nor should you expect an F1 car to be the same price as a Honda Civic. Does that make sense? I hope it does. I want to give that little illustration out there, okay? Alrighty, guys, you ready to rock and roll? I'm ready for you. I hope you guys are excited for this one. Let's get into stock number 1 of these 5 stocks. And remember, I'm going to give you an honorable mention in the stock in this video as well. And the honorable mention is not a stock I even personally own right now, but I'm going to give it to you, okay? Stock number 1 of these 5 is Celsius Holdings. Celsius Holdings, what a stock. It's up 700+% over the past 5 years. Now, remember what I told you guys about volatility in these ultra high growth stocks? Celsius is a perfect example. Look at that stock. I mean, look at the volatility the stock had. You gotta understand, a lot of these moves down were 20, 30, 40, 50% moves down at particular times, with this stock. I mean, incredible, right? I mean, this one, vicious to go through, right? And even recently, it's had some volatility on the downside. So just understand, it's not just up into the moon when it comes to investing into these sort of high growth companies. But at the end of the day, yeah, you had to go through a lot of BS in Celsius over the past 5 years. You had to go through countless corrections and crashes in the stock, right? But at the end of the day, what do you have to show for it? A 700% plus gain over 5 years. Like, ask any investor, and they'll tell you, man, if I could make 700% return in 5 years, I don't care how many times that thing crashed and came back and crashed. Give me 700% in 5 years, right? No, when it comes to Celsius Beverage, this is a major energy drink company. I'm sure a lot of people know it. They're big in the fitness space as well. Obviously, they've kind of boomed over the last, I would say, 4 or 5 years, very big in gym culture and things like that. Now, additionally, they just acquired this other brand here in the past few months called Alani. And Alani's kind of similar to Celsius. It's also grown big in the gym community as well, kind of the fitness community. It's also an energy drink, right? But the difference with Alani is I feel like is very focused. Alani seems to skew heavier toward like a female customer base, essentially, okay? Whereas Celsius, I wouldn't say Celsius necessarily skews toward females or males. It's kind of a little bit more even, but Alani really skews heavier toward a female consumer base for the most part. I mean, some men still drink Alani, but it's just like, I don't know what it is, but there's something about that brand that just resonates more with the female customer base. Now, additionally, they just acquired this brand from Pepsi, which is called Rockstar. That's been a popular brand over the years, but it only has a few percent market share as far as the energy drink category. That one competes a little bit more direct on with Monster Energy and with Red Bull. So do keep that in mind, okay? Now, the other thing you got to understand about Celsius is Pepsi's now a major investor in Celsius, essentially. Now, Pepsi has done this deal because they probably believe they're going to make a lot of money on this, and they're getting the distribution. So now that Celsius is set up in this position, like Celsius can get distribution all around the United States of America, and they'll be able to eventually get massive international expansion as well. Now, Pepsi I feel like they had to make this deal, and the reason being is Pepsi didn't have a good energy drink strategy, and we know this is a massive category, right? In a category that continues to grow. Coca-Cola years ago made a major investment into Monster Energy, and from my understanding, Coca-Cola owns around 19% of Monster Energy. Now, both companies have benefited in a tremendous way from this. Monster because of the distribution, and Coca-Cola because the stock's done very well since they made that investment, essentially, right? Plus, they get the distribution on that. Because somebody like a Celsius is not going to build out their own distribution network. Somebody like a Monster is not going to build out, their entire own distribution. Like, you'd much rather partner with Coca-Cola or Pepsi or somebody like that. So now we have Pepsi Celsius in a great position with them being this close to Pepsi, right? And Monster's that close with Coca-Cola. I think Red Bull is the odd one out in this situation, right? Now, look at this. Oh my gosh. Celsius's growth rates have exploded back higher again, right? This company was a company that was growing rapidly, right? 104% revenue growth, 94% revenue growth, 36% revenue growth, 23% revenue growth. And then basically what happened is they had to kind of a come down from that Pepsi deal that happened back in 23, right? And so they had kind of an over-ordering, over-distribution situation they had to deal with for a bit there, which was rough on their numbers, right? 30% down revenues. And then they kind of, they finished it off at like a 4 and 7% revenue down. But now they're back to major growth. Latest quarter, they just grew revenue 83%. The big growth days are back for Celsius, okay? So, Celsius is a major position for me in the public count. We're now up $109,000 on this position, up 112%. It's a $200,000 plus position. And if you told me, would I rather sell or buy some of those 4,000 shares I have in the public count, just to be quite frank with you guys, I'd rather buy the stock today at $51 and sell it at $51. There's too much growth opportunity for this company over the next 5-10 years. When you think about all the U.S. distribution and market share they could grab in just the United States alone over this next few years, but then when we think about the even bigger opportunity, it's outside the United States of America. And ask Monster about that. When they got that distribution outside the United States, that's been a lot of what Monster's growth has been really over this past 10 plus years. A lot of it's come from international. And so understand Celsius has a big international opportunity ahead. So Celsius, absolutely beautiful stock, okay? Number 2 of these 5 stocks, and remember I still got an honorable mention for you guys in this video as well. Number 2 is Elf Beauty. Remember what I told you guys about volatility, man. That was a major volatility downward move there. This was a major move. The stock's up so much since then, it doesn't seem like it was that big. It was vicious. This was brutal. This was brutal. This was brutal, right? But at the end of the day, what has Celsius given you over the past 5 years? 551% return. Now, when it comes to Elf Beauty, they're a very popular cosmetics brand. They built out huge on social media, Instagram, YouTube, TikTok, all those sorts of things. A lot of their products are priced under $15, and a lot of them are even under $10. So they're really affordable to the masses. They have now massive distribution, really almost in every retailer you want to be in, whether we're talking Target, Walmart, even Amazon, and honestly, they're under distributed even in those sorts of stores right now, like Target, like Walmart, and even in like the pharmacy chains and things like that. In my opinion, they're way over, selling product for how much is actually in the stores. So don't be surprised if Elf gets a lot more distribution in those stores and a lot more shelf space over the next 5 years, essentially, okay? Now, additionally, they just acquired this brand called Rhode, which was started by Hailey Bieber, essentially, okay? And this brand is like blowing up right now, like absolutely insane growth rates for this particular brand, okay? Now, additionally, they bought this brand called Naturium, which is very popular with like body washes and things like that back in 2023, and that one's been growing rapidly as well. But to that Rhode situation, okay, this news just came out here in like the past day, okay? Look at this. Rhode sets $15 million first day Sephora sales record, outperforming celebrity beauty competitors. So supposedly, Hailey Bieber's skincare brand, Rhode, reportedly generated around $15 million in first day sales across North America at a Sephora launch on September 4th, setting a new record for celebrity brand retail debuts. What? Rode captured a substantial share of Sephora's total sales on launch day, with the data indicating the brand surpassed $10 million in revenue in its first 2 days. Reality T reports that this performance surpassed previous launch metrics from competing celebrity beauty brands, including Selena Gomez's Rare Beauty. She must have loved to take that W. If you know, you know, in regards to that whole Bieber's. Okay, I'm not even going to go down that rabbit hole, okay? And Rihanna's Fenty Beauty. This blew Fenty out of the water, a source close to Sephora told Reality T. Multiple New York Soho locations reportedly sold out of Rhodes products within hours of the rollout, and with full restocks not arriving until the following week. Quote, so many stores are sold out. How could they have messed that up? Questioned one person familiar with the rollout, suggesting that inventory challenges may not have been anticipated, right? Which, yeah, you can say they could have made more money in the short term if they had more product on the shelf, but guess what, man? Now all those customers go to the store, they see all that product out of stock, it all sold out. I mean, it looks good, right? It looks good. It looks really good in terms of like, wow, this product's so hot, it's so in demand, like they can't even keep it on the shelves. So do keep that in mind, man. There's a whole game to play there, okay? No, the thing with e.l.f. Beauty, right, is this a company that was growing at just ridiculous clips. 77% revenue growth, 84%, 71%, 50%, 39%, 31%. And the last few quarters were very sleepy growth, 3%, and then the very latest quarter was 9%, right? Now that the Rode acquisition's done and the e.l.f. brand's going to get back to very strong growth, in my opinion, as well. We're going to see insane revenue growth start as early as this upcoming quarter. It's going to knock people's socks off. They're not prepared for what e.l.f. is about to start putting up in terms of revenue growth. It's going to be unbelievable, here on out. Now at this point in time, okay? No, e.l.f. is a stock. Where's the stock price headed? In my opinion, it's headed to 200 plus in the next 9 months. I don't think there's any way it doesn't. And the reason being is when people start to see these growth rates, the revenue growth rates, they're going to flood back into e.l.f. over this next 9-month period. When they see those sorts of growth rates that are going to hit, oh my gosh. And they listen to conference calls, right? Because for this next, I would say, year or two, it's going to be all about the revenue growth again, right? And then probably 27, we start worrying about margin growth again, profitability growth, earnings per share growth. But e.l.f.'s about to have the big growth rates. And man, when e.l.f. has those big growth rates, the stock runs big. Like I watched e.l.f. run from 50 to 200. I watched e.l.f. run from 10 to 50. And a lot of it comes down to, do they have the big growth rates? And they come through with those big growth rates, you're flying, baby. You're flying. And remember, e.l.f., you think this is the last acquisition they're going to do? No, of course not. They're going to keep buying out companies. They're going to keep buying out companies over time, right? They probably won't buy one for a bit because they're going to have their hands full for at least the next year and a half with this Rode acquisition and making sure they get distribution all over the United States for that. So they're going to have their hands full for a bit, but don't be surprised if in 2027, 2028, they buy another big brand, right? That's growing rapidly. So, they're now becoming, what Estee Lauder really was, from really, I would say the 80s all the way to 2015. I think that's what e.l.f.'s becoming, right? Just e.l.f.'s competing in a different way, right? A little lower price. Alrighty, guys, stock number 3 of these 5 stocks. This is a forgotten high growth stock, okay? This one, you don't, because a company's so large, you don't think about this one as a high growth company, right? Look at the company's growth rates. 23% revenue growth, 24%, 27%, 22%, 19%, 20%, 16% in the latest quarter they just reported, 21.6%. It's beast. It's basically a company you can count on growing 20% clips, right? Unbelievable. Beast. What stock is this? It's forgotten. No one thinks about this one when they think about ultra high growth companies. You know what it is? Meta. The biggest position in the public account, a $1.2 million position in the public account. A stock that I've made over $1 million. I made 7 figures on this stock. That doesn't even account for all the profits I've taken or shares I have in other portfolios, right? Meta, this stock is still a buy. This stock is still a heavy buy. Now, when it comes to Meta, we all know Meta. They own Facebook, they own Instagram, they own WhatsApp, right? And those are great growth engines for the company. Even Facebook still grows nowadays. I'm shocked. I'm like, how's that still grow? Like, I can understand Instagram's still growing, and I believe Zuck just came out and said Instagram's up to 3 billion users now at this point in time, which is unbelievable, right? WhatsApp continues to grow aggressively, and WhatsApp still is very early days in the monetization cycle, so understand so much revenue growth and profit growth is going to be coming from WhatsApp over the next, I would say, 5 years, okay? But here's the deal. Meta's spending a fortune right now. Right? They're spending a fortune on CapEx. They're buying all these chips up, right? They're building massive data centers. We all know this, right? And they're spending aggressively for future, right? For future growth. And you got to understand, Zuckerberg's not going to spend aggressively like this unless he's very confident that there's going to be a payout much bigger than what they're spending right now. So if Meta spends $20 billion a quarter on CapEx, just believe Zuckerberg's probably very confident that they're going to get a lot more than $20 billion back from that $20 billion to spend down the road, right? It's not going to happen in the short term, but over the next 5-10 years, they'll get it back, right? No, additionally, they're not just at the forefront of AI technology and how that's going to help all their businesses and also boom new future businesses for the company, right? With the llama models and everything going on there. But they're also innovating rapidly when it comes to virtual reality, augmented reality, right, and wearables. And so you look at even like their new AI glasses they just launched here, they look phenomenal, including they launched these ones, which are called Meta Ray-Ban Display for like $800. I'm like, this is insane technology for like $800. Like, you know, if you want to check it out, check it out. But basically you have wrist gestures and everything like that. Like, it's incredible. Check out the technology. Unbelievable what Meta's doing and how they're innovating in regards to all that tech, right? Now, Zuckerberg, some people look at him, they're like, that man's a gambling fool, because they see him spending so aggressively. And the man's always done this. When he acquired Instagram for $1 billion, which, by the way, if Instagram was a standalone company, it would be one of the biggest companies in the world today. When he acquired Instagram for $1 billion, people were like, what are you doing, Zuckerberg? Are you mad? You just spent $1 billion on a photo app that's basically generating no money? Are you insane? Now we look at Instagram and we're like, that's one of the most powerful, if that was a standalone company, it's one of the most powerful companies in the world. 3 billion users now? I mean, I spend too much time on Instagram, right? I think everybody spends probably too much time on Instagram. It's incredible. And he bought it for $1 billion, and that was questioned. They thought he was a gambling fool. Then he buys WhatsApp for $19 billion. People lose their minds. $19 billion for a messaging service? What are you doing, Zuckerberg? Are you mad? Guess what? He then integrated all that technology into Facebook, into Messenger, right? Into Instagram. And then WhatsApp is worth a whole lot more than $19 billion now at this point in time, right? Then he spends the money to launch Threads, which is an X competitor, formerly known as Twitter, right? And Threads, from what I last heard, I believe Threads is now up to 300 million plus users, and it continues to be one of the most downloaded apps out there on a day in, day out basis. So Threads looks like that was a great investment, Zuckerberg, right? Everybody's been questioning all this VR, AR stuff, right? And all the spend there. And I think they're starting to get the early glimpses of like, oh boy, like this is actually kind of getting interesting now at this point in time, right? Imagine where this tech is in 2 years from now, 4 years from now, with how rapidly they're innovating here. Right? And so now he's spending fortunes of money on AI. We're already starting to see some AI payoff, by the way, in regards to the recommendation engines working even better, in regards to advertisers getting their ads seen in more places that, let's call it, would be valuable places. Because at the end of the day, the whole game for Meta, that I gotta explain to everybody, the whole game is Meta wants to make their advertisers as much money as possible. And you can make your advertisers a lot more money by, guess what? Keeping your users on those platforms for longer periods of time and showing them more relevant ads that they might actually use and buy. Because if you do that, guess what? Those advertisers then are going to spend more money with you, which means Meta makes even more money. That's why at the end of the day, if you know anybody that really runs a small business, mid-sized business, or even a large business, and you ask them where you want to advertise, they're going to say the first two places they're going to say Facebook and Instagram. Everything else comes after that. I got to advertise on Facebook and Instagram. And then you can worry about all the other platforms, worry about them after that. But you better have a massive budget for Facebook and Instagram, because that's where you're usually, if you talk to anybody that basically runs a small business, mid-sized business, or even large business, that's where they usually get the best return on investment. And the crazy part is nowadays, it's whether you're selling B2C, like that's an obvious one, but even a lot of B2B now is starting to be spent on those platforms. So do keep that in mind. Where are my projections for Meta stock over the next few years? Well, let me show you my bull case, my base case, and my bear case for Meta. Here we go. This is my bull case for Meta. So this is things go great for Meta. Better than I expect, okay? So better than I expect would be 20% revenue growth on average per year for the next 4 years, okay? Now keep in mind the company has, just last quarter they grew faster than 20%. So it's not out of the realm of possibility that they could do a 20% growth rate over the next 4 years, right? Net income growth a little bit faster than that at a 22% clip. That puts them at net income margins of 39% come 2029. Now, if you get a company growing 20% top line, 22% bottom line pretty consistently, you could command a P somewhere in the 35 to 45 range, which would mean Meta stock would be priced somewhere between $2,200 and $2,800 come 2029. This is a stock that's in the 700s right now, folks. You think you missed all the money on Meta? I don't think all the money has been made yet. I think there's a lot of money still to be made, right? Which gives you a compounded annual growth rate on the low end of 31%, on the high end 39%. Now you might say, well, that's great. That's a bull case. That's if things go better than you expect. What about what you actually expect, Jeremy? What about that situation? Let me show you the numbers. This is my base case for Meta. In my base case for Meta, I have them growing 15% per year on average revenue growth from 26 to 29. And then doing 18% net income growth, so a little faster clip than the revenue going up essentially, okay? Puts them in net income margins right around 40% come 2029. Now, if a company's growing top line 15%, bottom line 18%, a 29 to 34 P is extremely fair. Extremely fair. Honestly, it's probably too low, but Meta usually trades a little cheaper than average stock. So we're going to go 29 to 34. Guess where that puts the stock in 2029? Puts it between $1,600 and $1,800, right? Which gives me a compound annual growth rate that's in the low 20s. Come on, man. It's a buy. It's a buy. And once again, this is revenue growth is at a much slower clip than what they've been growing at. And that's my base case. It's a buy. What about my bear case for the stock? My bear case, this would be things go awful for Meta. We have a massive worldwide recession that affects the economy for 1 to 2 years. So that means they only grow at an average clip on revenue of 10% per year, right? And 10% net income growth per year, okay? So 10% top line, 10% bottom line, 23 to 28 P is pretty fair for that. That puts the stock in 2029 somewhere between $962 and about $1,200. Gives me a compound annual growth rate of 6% on the low end, 11% on the high end. It would still outperform the S&P 500. Meta stock will still outperform the S&P 500 over the next 4 to 5 years, even in a bear case. That's when you know you got one, okay? So that's why I continue to hold Meta. What am I going to do? Sell my $1.2 million of Meta stock or whatever in the public account to go where? Where else am I going to get a base case, for a company that has this much safety, this much business model, right? That many massive services. We're talking about Facebook is massive. Instagram's we're talking about they own so many of the biggest platforms in the world. And Threads, honestly, is on a trajectory that don't be surprised if in 2 or 3 years, that's one of the biggest platforms in the entire world. It's incredible. And then they're at the forefront of AI technology and at the forefront of AR, VR, and wearables. Come on, man. It's a buy. It's a buy. Alrighty, next one up here, number 4 of these 5 stocks, and then we'll get into the honorable mention as well, is AMD, Advanced Micro Devices. Now, this stock actually, over the past 5 years, kind of been, of these stocks, it's kind of been man stock. It's kind of disappointed people over the last 5 years. It's only up 75%. Now, by the way, even a 75% gain over 5 years is pretty dang good. But considering, the other stocks we're sharing in this video here today, it looks kind of like a sleepy performer, right? Now, whenever you think about AMD, the subject of Nvidia comes out, okay? People start thinking about Nvidia. Nvidia's up 1,200% the past 5 years, blowing AMD out of the water when it comes to performance, right? Here's the deal with Nvidia. They got out in front. I'll put it the simplest way possible. They got out in front with the AI chips. They got out in front. And so they beat AMD. If this was a 400 meter, Nvidia got to a big lead in the first 100 meters while AMD was still in the blocks, right? But now because of Lisa Su's acquisitions and also what the team has done in the chips they built, now Lisa Su's finally in position to get in the race. And so AMD has now started the race, and now they're catching up rapidly with Nvidia. And I mean rapidly. Like, you look at how far AMD was behind 18 months ago or 24 months ago, and it was like, oh my gosh, like AMD's not even in this race. And now you look at the tech that AMD has out there with the MI350 series, and you're like, okay, AMD's actually in this race now. There's a big change that has transpired, right? Now, when it comes to AMD, right, they already have started to accelerate their revenue growth in a great deal. And I think they're going to hit 50% plus type revenue growth, right? But look at this. They went from 2% revenue growth, we can call 6 quarters ago, to this latest quarter, 31%. That's a major acceleration here. Now, I'm looking at analyst expectations. I think they're so bearish. So bearish. Analysts have them growing 27%, 19%, 18%, 24%, 20% over the next 5 quarters. Now, for an average company, that's great, right? And it still would be considered like ultra high growth even, right? At 20% plus clips. But listen, I think they're way low. I think analysts are clueless. I think analysts are 100% clueless, and that wouldn't be the first time if you've been watching my channel for many years. We know analysts are usually clueless, okay? I'd be shocked if AMD doesn't grow at least a 30% plus clip every quarter. Shocked, okay? The question for me is not, are they going to grow at a 30% plus clip for these next many quarters? My main question is, are they going to grow at like a 40 or 50% clip? Because I don't think those are the numbers people are anticipating. Remember, analysts were 100% wrong on Nvidia. 100% wrong. Look what analysts were expecting for Nvidia. When Nvidia really started getting in that AI wave in 23 and into 24, look what analysts were expecting for numbers. They were way too low. And Nvidia would just come out and just blow the numbers out of the water, right? And that's why Nvidia went up 1,200%, right? Because people were like not expecting those numbers, and then they would just come out and just shock people, and it'd be like $1 billion, $2 billion, several billion dollars better than expected. And the guidance would be several billion dollars ahead of where analysts were at. And analysts were like, what the? That's exactly what's going to happen with AMD, in my opinion. We'll see. Maybe I'm wrong. I don't think I am. I do not think I am, okay? Now, here on the main channel, Financial Education, I put out several videos on AMD that go very in-depth over the past 6 months. You can find those AMD videos on the main channel here and watch those if you want to hear me talk all about the MI350 series and what's coming down the pipe with the MI400 series next year and all those sorts of things, okay? You can get into all that fun. Yeah, okay. Alrighty, next up here, let's go for an honorable mention. Honorable mention, okay? It's a food company. Not tech related. This honorable mention is a food company, and it's a very high growth company, and it's kind of intriguing to me. You know what it's called? It's called Cava. Cava. So picture Chipotle, but Mediterranean food. Cava. Okay. So I've tried it several times now. I tried it in Arizona several times. I tried it we don't have any locations in Vegas yet. I'm sure we'll have some very shortly in Vegas. I tried it in New York City several times. Really good. I'm really impressed. It is a place that I would go to very often. As in very often, I would say like way more often than I go to Chipotle, for instance. Okay. I like it a lot. Now, with this Cava, if you look at their revenue growth, it's been pretty extraordinary, right? 27%, 27%, 26%, 36%, 27%, 35%, 38%, 28%, 28%, 20%. As a 20% plus grower, like quarter in and quarter out, it's an ultra high growth company, which is pretty darn intriguing, and they've got a lot of location expansion over this next decade, essentially, right? No, the reason I haven't started a position in Cava yet, okay? This one's on my watch list. I haven't bought it yet. I do like it as an ultra high growth company. It's really around the valuation of the company. I look at a forward P of 111. It's high, right? Very, very high. Now, of course, the company, if they can keep growing at 20% plus clip a year for a long time to go in the future, like eventually that forward P will look cheap, right? And we'll look back at Cava and it'll be a $20 billion or $30 billion or $40 billion company. And we'll look back at the days we were buying it at $7 billion and be like, dang, that was a steal, right? But it is something that kind of scares me, because you kind of look at a P that high and you're like, dang, if the growth rate slipped for even a couple quarters, could the stock go down to $40 or $30? It's possible, right? Which would be, dang, that'd be some downside. And that's the risk that you take when you buy these ultra high growth stocks. Like this one's already kind of crashed. It was a stock that was well over $100. So it's already crashed, but there's no telling where the crash could end. Like, it could end at $30, and that's kind of the risk you got to take in regards to these stocks. So the reason I haven't really bought it yet is I look at something like Cake. Cake has the next 10 years of growth with their Flower Child concept and North Italia concept, right? But it's far less risky. The forward P on Cake is 15, 2-year forward P at 12, right? It's just with Cake, I'm not getting that ultra high growth. Cake is more of a, it has growth, like next year expected revenue growth is 7%, right? That's good growth, but it's not ultra high growth like Cava has, where they've been growing at a 20% plus clip. But for me, I just feel a little safer in Cake, and that's why every time I go and I'm like, should I buy Cava today or should I buy Cake? I always end up buying Cake, even though it's not ultra high growth, right? So tough, but I'm keeping a close eye on Cava. If that baby keeps falling, I might have to eventually start a position. I might have to do it, okay? It's hard for me to buy Cava right now at that sort of PEs versus Cake. And I'm like, geez, man. So anyways, and Cake's also a well-diversified business. Cava's counting on one concept, right? Cake's got the Cheesecake Factory concept, which was a banger all over the United States of America and even around the world. We know that. But then they have North Italia, which is a banger concept of expansion, and then Flower Child as well, plus a bunch of concepts behind that. I'm like, kind of got to go Cake, okay? Already, that was honorable mention. Number 5, I don't know why I did 3. Number 5 of these 5 stocks up here, ultra high growth, is SoFi. If you've been watching my videos the last couple of years, you've heard me talk a lot about SoFi. I love this stock. It's been a great stock over the past 5 years, up 158%. This is also a stock that I want to remind everybody. This was a $6 stock last year. $6 last year. It's $28 now at this point in time, right? Now, when it comes to SoFi, they're kind of put into more of the banking space, fintech type company, right? They do banking related things, but they try to keep it a little, Anthony Noto, the CEO that runs the company, he tries to keep it more asset light than a traditional bank. I'd put it like that, okay? And so they're really capitalizing on, I would say, the younger generations that really want to be mobile first when it comes to their banking, right? Whereas we can call it the older generations really want it to be branch focused. How many branches do you have, right? And that used to be the battles back in the day. Wells Fargo, Bank of America, Chase, all those guys. It was all about how many branches do you have? How many ATMs do you have? That was the old battle, right? And that's why Wells Fargo, Bank of America, Chase, all those companies just loaded everywhere you could possibly have with banks. On every corner, every popular corner in the United States of America, you can find a Wells Fargo, Bank of America, or Chase probably on it, right? Or one of the other big banks out there. And that used to be the game, but the game has changed now. It's not about branches. It's about being online first, especially for the younger generations, right? And so SoFi is very well positioned for that, and they're capitalizing, right? Now, the revenue growth of this company is exploding upward now at this point in time, right? So we're talking about a company that's in that ultra high growth category. You look at they call them members, I call them customers, went from 8.7 million at this time last year to their latest quarter, 11.7 million. Right? And you got to understand, when somebody that's a fintech / bank acquires a member, you got to understand the payoff on that is not really initial. You might think, okay, they acquired a customer, okay, boom, that's it. No. When my first bank account I ever set up was through Chase. Chase paid me $250. This is when I was like 18 years old, okay? They paid me $250 as long as you set up direct deposit. My first job was at Einstein Bagels, cleaning dishes in the back for like $7.50 an hour, okay? But since I had to have my direct deposit go into the bank account for 90 days, after that 90 days, I got $250, which, by the way, when you're making $7.50 an hour, $250, like, let's go. Why did Chase do that, though? Why would they do that? That seems kind of silly. Because Chase understood, if we get people that are younger to sign up for a bank, we're going to make a lot of money over the time. A lot of dang money, right? And I'm sure Chase has made a lot of money off me over the years. Have they not? I'm sure they got way more than their $250 worth. So when you see SoFi acquiring this massive amount of customers, just understand this payoff is going to really be a year from now, 3 years from now, 5 years from now, 10 years from now, 20 years from now. It's not just about, oh, they got a new member, like, that's it. No. It's about, okay, somebody signed up for SoFi because they want to set up a savings account, right? And next thing you know, they go get a home loan through SoFi in a few years, a car loan through SoFi, right? or they use other products, they invest through SoFi, et cetera, et cetera. And obviously there's a million different ways SoFi can make money off of all that. So that's an important thing you got to understand about SoFi. The big payoff, it's coming. It's coming down the road, okay? The stock's already starting to be a big payoff. Now, keep in mind, these growth rates SoFi have been putting up, this is all despite a horrible loan environment. I mean, you could make an argument this is the worst loan environment we've had in 15 years. Could you not, right? When you think about, like, who's all out there searching for a car loan right now? Or a home loan, things like that, right? Or even a personal loan. Like, you know, it's not a great environment for that. And so understand things will eventually change and people will start buying lots of cars again and homes and things like that. And guess what that's going to be for SoFi? I see it as nothing but great things for SoFi, right? So SoFi, I like that one a lot, okay? Jerome Powell, the big dog at the Fed, says stocks are highly valued. I want to react to this. I want to give my in-depth thoughts about basically Jerome Powell, the head of the Fed, basically saying the stock market's overvalued. Like, it's as simple as that, right? And so I want to kind of give my perspective on this. This is the most interesting comments, in my opinion, we've seen since Alan Greenspan came out way back in the 90s when I was still in elementary school and said basically the stock market was irrationally exuberant and alluded to, you know, the stock market being overvalued at that particular time. And so I even want to take you back and show you exactly how much the stock market went up between essentially Alan Greenspan saying that and where the NASDAQ actually ended up topping at in 2000, which is going to be very interesting, okay? So we'll talk about that subject at the beginning of this video. Then we're going to talk about Micron for a minute here. MU is a very important company to the entire stock market. And the reason being is they're one of the biggest memory chip companies in the world. And you got to understand, like, all this technology, all these, Nvidia chips, everything that's really going on out there, they all have to use memory, right? And so MU is a big beneficiary of this. So I want to show you what's going on with MU numbers and kind of talk a little bit about that and what that means for the stock market, okay? From there, we're going to react to two clips in this one. This one here, momentum is powerful, and there's a lot of it in this market, says this gentleman. So looking forward to reacting to that clip. And then the guy that used to be the big bear, it's not a bear anymore, Mike Wilson, Morgan Stanley. The early cycle rolling recovery has begun. So looking really forward to reacting to that one in this video here today. Appreciate everybody joining me as always. One thing and one thing only I need from you guys. If you could please just hit that thumbs up button. If you could just make that thumbs up button glow for me, you are my hero. Additionally, if you want to see more of my videos here on the Reaction channel in the future, make sure you're subscribed to this channel. We have nearly 110,000 subscribers now on the channel. I appreciate each and every one of you. Okay, so Jerome Powell comes out, says what he says here today. Okay, stock market's highly valued. Okay, listen. Alan Greenspan, the big dog at the Fed at the time, back December 1996, had a speech, right? And basically, he was talking about the tech stocks and how much they had rolled and all these sorts of things because essentially the stock market had been in kind of a beast cycle going into this speech that he did on December 5th, 1996. Okay. And market conditions, the NASDAQ had nearly doubled in less than 2 years. Which is interesting because if you look at where we bottomed at in 2022, right, we can say the fourth quarter of 2022 versus where we're at now in the stock market. Let's go ahead and take a peek at this. QQQ, let's pull it up. And let's go ahead and take a look at that bottom of 2022 to where we actually are at now. And we're going to find the NASDAQ has well over doubled since that bottom in the fourth quarter. NASDAQ's up all 129%. Woo-wee! So we have very similar market conditions that we had when Alan Greenspan did his speech there and said the market was irrationally exuberant, essentially, okay? Now, I went to Google Gemini and I said, okay, how much did the NASDAQ go up after Alan Greenspan's irrational exuberant speech until the NASDAQ bubble popped in 2000? It says, between Alan Greenspan's irrational exuberance speech on December 5th, 1996, and the peak of the dot-com bubble March 10th, 2000, the NASDAQ composite increased by over 280%. Greenspan's speech was widely interpreted as a warning that the stock market was overvalued. While it caused a brief market dip, the NASDAQ quickly rebounded and continued its meteoric rise for more than 3 years. Whew. I mean, the NASDAQ, when he did that speech, was around 1,300, and the NASDAQ at the top was just over 5,000. So, you could look at this and you say, okay, the stock market's overvalued, and we'll look at the Shiller P in a moment, and I'll talk about that. But at the end of the day, Alan Greenspan he honestly had a good case that the stock market was overvalued at that time, and it was irrationally exuberant, right? No different than Jerome Powell's got a strong case right now that I'm going to run you through, right? But at the end of the day, that does not necessarily mean that's going to be the end of the stock market. Like, the stock market went up another 280% over the next few years, right? Fortunes were made over those next several years after this. And also fortunes were lost after the bubble popped in 2000, right? But between this time of this speech and when the bubble popped, I mean, you could have made life-changing money, right? So that is something to kind of keep in context here when you're at a new major technology, which right now, obviously, this is an AI big cycle, right? Which some people say is as big as the internet was. Some people say it's bigger. Some people say it's not going to be as big. That's for debate. But we know it's a big thing. There's no debating that, right? Like, AI is a big transformative thing in the world, right? And the technology is going to be, it's already extremely important to a lot of folks, right? I mean, look at me. I just use Google Gemini, right? Like, there we go. We're already using AI, right? People using ChatGPT and, Anthropic and all these other different things, Claude. And so, and then all the other, AI platforms like Palantir. Yeah, it's going to continue to build out for a long, long time. And it's going to be a very massive category, right? Now, with that being said, there is something we got to take very, very serious here. Very serious, ladies and gentlemen. Listen. The Shiller PE, okay, which basically takes the 10-year, earnings of S&P 500 companies, inflation-adjusted earnings from the previous 10 years, okay? And so it's different than like a normal PE ratio that would just be looking at what companies earn over the trailing 12 months versus, the S&P 500 right now. This is looking at the 10-year average, which inflation-adjusted earnings. So keep that in mind, okay? But the Shiller PE, not my favorite metric, but it is one that's highly looked at in the stock market. Guess what? The Shiller PE is getting close to where we topped at in the tech bubble. It's getting close, folks. We're at a 40 right now, and where we topped at in the tech bubble was 44. That's something to keep in mind here. Now, if you look back at, where we topped at with the Shiller PE back when the market topped in the fourth quarter of 2021, right? We were at a 38. And then obviously we had a massive drag down in 2022, and the Shiller PE at the lows got all the way down to 27 here, okay? So right now we're much higher on a Shiller PE basis than actually we were in the fourth quarter of 2021, which is when we had all that stimulus money out there and the PPP loan money, and that was before inflation really sliced and diced the middle class. So, there's a strong argument to be made that, if the economy went off the rails, if the big dogs, when I say the big dogs, I'm talking about the Mag 7 type stocks, if those ones' earnings, let's say the growth rate started to stall out in 2026 and started to, let's just call it disappoint, you have a strong case to make that the stock market, and when I say the stock market, I'm talking S&P 500, could go down 20 to 50%. You could make a very strong argument, right? I mean, if we got the Shiller P at 40, I mean, a 50% fall, then you're at a Shiller P in the 20, a 20, which isn't crazy. Like a Shiller P at 20, that we've been there many times before. Now you can say, okay, maybe we don't get a 50% hit, but maybe we get, a 25% hit or something like that. That puts us at a Shiller PE at 30, right? Which isn't crazy. I mean, that's where we were back in 2023, for instance. So, yeah, I mean, there's, and the Shiller P, by the way, got all the way down to 13 in the 2009 lows. So, yeah, if you ever see the Shiller P ever go down to 13 ever in the future, ladies and gentlemen, load the boat, okay? Like anything under 20, load the boat. But especially if you see it ever go under 15, just buy. I don't care what's going on in the world, but buy, okay? But the moral of the story is there's a strong argument to be made that the stock market is overvalued. There's a strong argument to be made if earnings slow down in 26, that, the stock market could go down 25%, and maybe even 30%, maybe even 40%. And so that wouldn't be crazy. But there's also a strong argument to be made that earnings are going to increase more rapidly because of AI, which means, the Shiller P could potentially even increase in the short term because you could have companies' earnings going up so rapidly over this next year or two if the AI profits really start to pour in and they're able to do cost cutting measures through AI, right? But remember, the Shiller P is looking at a 10-year average. 10-year average. So if you're these companies and your earnings per share blow up, in a positive way, that is, over the next 1 to 2 years, that's not going to be fully reflected really in a Shiller P because it's taking a 10-year average here. So these are also things to keep in mind. So that's where you get in this situation where it's like, could the stock market continue to explode higher for the next 2-3 years? Kind of like it did after Alan Greenspan's speech? It could. It could. Like that's a potential as well. And that's why it gets really difficult to try to make a strong case that the stock market's doomed or something like that, right? Now, how do you prevent yourself being into a lot of problems in a stock market where you got a Shiller P at 40? Okay, here's how you do it. Let me show you exactly how, okay? What I'm showing you right now is the public account. So the public account's very well protected from downside in the market. Now, if the stock market goes down 25-30%, the public account's going down as well. There's no protection as far as like, oh, the S&P 500 went down 30% and I didn't get hit. No, it doesn't matter what your portfolios consist of. You're getting hit as well, okay? But the main thing, the main way I protect myself in a market like this where you got a Shiller P at 40 is I keep myself invested into the most top quality companies that have some of the most impressive income statements and balance sheets and cash flows you will find out there. These aren't the sort of companies that you're like, oh, is this company going to go under? Something like, oh man, like maybe they're going to go bankrupt if the market turns south, right? These are sorts of companies that have phenomenal growth regardless of the economy, regardless of what's going on. You look at companies like Meta, you look at companies like AMD. I mean, these are top tier big tech companies. Amazon, top tier company. Like Amazon's growing no matter what, right? Celsius Holdings has major growth in their business model, drink maker, right? Elf, cosmetics company with very high growth. SoFi's an ridiculous growth rates at SoFi right now and continue to accelerate those growth rates. And that's a stock that will get hit hard the next time we get a bit major downdraft in the market, right? But for now, it's green, right? You look at a company like Nike, that's a great turnaround play there. Palantir is, it's the creme de la creme in the stock market of the last few years. I mean, the growth rates are ridiculous. They just keep accelerating them. At some point, the growth accelerations will end with Palantir. But it's not today, right? But eventually Palantir is going to stop accelerating these growth rates. Who knows where the next quarter's growth rates are? Maybe it's less than what this past quarter was, or maybe they accelerated even higher. So which would mean they accelerate to the 50s. The 50s when it comes to revenue growth. It's possible. And maybe they take it a little higher from there. Maybe they go 55, 58%. But at some point in time in the next few quarters, eventually they'll start to decelerate that growth rate. But for now, it's party on, right? Cake, that's just a company that is at a low valuation on a forward P basis, and they have growth for the next 10 years locked away, right? And so you look at these companies, like PayPal trades at such a low valuation, you can't do much with that stock in terms of getting it down in any significant way, right? Adobe's very attractively valued. Google's very attractively valued, right? Fubo, you can make an argument that's kind of a speculative play. So, there's an argument to be made there. Yeah, that one might come with more risk, but it's a small position. It's 2% of the portfolio. Honest isn't even that risky anymore. No, when you look at their business model, when you look at now they're starting to be profitable, now you look at their balance sheet, it's not even really a risky play anymore. And even if you did consider it a risky play, it's 1.7% of the portfolio. Revolve continues to be an impressive company with an impressive management team there, right? Up 111% on that. CRM's just a beast. The Planet's definitely a very speculative stock, but that's 0.5% of the portfolio. It's literally nothing, right? So you look at, that's how you really protect yourself for these sorts of markets. You'll always get hit, but it's not about do you get hit or not get hit. It's about do you make it out to the other side just fine. And throw a 50% crash in the market, that would be great financial crisis. Public account will make it right out to the other side. Will it get hit at? Absolutely. But you throw a 50% crash at it, it's going to make it out to the other side just fine. And, we'll then be reaching new highs a few years later. So that's all good. Now, as far as MU, it's very important for the stock market, very important that investors understand what's going on with here with MU. One of the most underrated, important stocks in the market, okay? Listen, you want to see an A+ income statement? Let me show you what an A plus income statement looks like right here, ladies and gentlemen. Let me drop some gems for you, okay? Listen. If you look at revenue growth, it's very strong. They went from $7.7 billion of revenue in the same quarter last year to $11.3 billion. That's very, extremely strong growth rates when it comes to revenue, right? Cost of goods sold didn't increase nearly as a rapid pace as revenue did, so their gross margin exploded. Like their gross profit went to over $5 billion from $2.7 billion. As far as their gross margin percent, I calculated here is 35% in the same quarter last year, and now it's at 45%. 10 whole percentage points? That's ridiculous. Like what? 1,000 basis points of improvement in gross margin on a year-over-year basis is extraordinary. Research and development, that was up for the company, but at a pretty tame pace. Selling general administrative was up for the company, but at a very tame pace. I mean, look at revenue. Revenue was up like, $3.5 billion or more than that on a year-over-year basis, right? And yet we're looking at, SG&A up nothing. Like it's up $19 million on a year-over-year basis? Is nothing, right? Had a little restructuring charge there. Operating income $3.6 billion from $1.5 billion, so they well over doubled up their operating income. That's very impressive. So I love to see a company that their revenues are increasing, by very, very strong double digits like it is for Micron, but then their operating income is increasing way more rapidly. Like we're talking, this is over a 2x basically on a year-over-year basis. Now, additionally, you look at net income, $3.2 billion from $887 million the same quarter last year, diluted EPS $2.83 for 79 cents. That's an A plus, man. Well done for Micron. And Micron's going to continue to put up great numbers throughout 2026. The question is 27 and 28. But listen, Micron's got the next, I would say, 4 to 6 quarters made. They're going to be reporting record number after record number after record number. And the reason being is Nvidia continues to expand rapidly. AMD is going to hit the afterburners over this next few years with their chip cycle. So between Nvidia and AMD just reporting, by far and away record revenues over this next 1 to 2 years, Micron's set perfectly for this next 1 to 2 years. Now, there's a question as 27 goes along, what do MU numbers look like? And then especially in 28 and beyond. So the moral of the story is Micron's a great setup for the next 4 to 6 quarters. And then after that, we'll see. Because after that, it's going to be like, well, are people actually making money from all this AI stuff? Did we way overbuild? And then companies are going to have to reassess. If there's a situation where we did way overbuild in 23, 24, 25, 26, then we're going to have a major slowdown in 27, 28, which will then mean Micron's profitability starts to get hit probably, second half of 27 into 28. But for now, it's party on, right? So that's kind of the dynamic you have playing out in a situation like that right now, okay? Now, next up here, let's react to a couple videos.
Strategist at Carson Group. He has been long. He has been correct for years. It's like you and Tom Lee and a few others, Ryan, have been.
By the way, folks, if you're looking to apply Jerome, a private stock group, private wealth group, I'll put that as a pinned comment down there today. That's access to all of my course curriculums, access to my private Discord chat, which is right here, access to see the stocks I'm buying and selling each week, access to exclusive weekly videos, all that good stuff. That will be the pinned comment down there, and this gets you up to a much higher level than where you are at currently.
Sticking to your guns even when others kind of waffled just a bit. What are you seeing now in the markets that make you continuously bullish?
Yeah, Sully, thanks for having me back. Appreciate it.
Oh, by the way, I apologize about the noise. Sometimes people complaining if I do ever have my Discord chat open, but there's always a lot of people posting in there. We have over 2,000 members, a ton of people in the 6-figure, 7-figure, 8-figure club. So, it's always busy in there, man. There's always a lot of people talking, especially Monday through Friday. Those are the busiest days.
So, first things first, late September, early October is a seasonal weak time. I know seasonals haven't really worked this year because we've been so bullish, but just big picture, when you think about it, we're looking at 5 straight up months, right? And when you're up these 5 months going into October, not too surprisingly, October is down on average. Okay, maybe you get a break. But here's what I think matters for the listeners. The fourth quarter is still up almost 6% on a median return, higher great majority of the time when you're up 5 months in a row going into it. So there's a lot more to it, Sully. But the reality, momentum's a powerful word, and we still think there's a lot of momentum to this bull market.
Yeah, but would you be happy with some kind of a pullback here, Ryan? Now, listen, I know it's painful. Stocks go down. We saw it in April. It stinks. It's like kind of gut-wrenching, but as somebody who's been doing this a long time, I get worried.
So this is important. That's very important what he just brought out there. Basically, October should be a down month for the market based upon historical data there, right? We should have a down month in October, but that doesn't mean it's a down necessarily quarter, which is interesting, right? But if you got a 2018 scenario to play out, we're going to be down the whole quarter, right? So that's something you do have to consider there. In 2018, market started to downfall. It was either the first or second week of October, and then it actually accelerated throughout November and got really ugly in December. So that is something to kind of consider, and this year has reminded me a lot of 2018.
Stocks go up every day. It's just not. It makes me nervous.
I'm with you there. We'd love it. We would welcome, say, a 4 to 6% normal, mild correction. Just a couple of things that do have our attention. Put to call ratios are some of the lowest levels we've seen all year. As I know you mentioned on your network a week ago, $58 billion to U.S. equity funds, like the most we've seen this year. So there is some optimism coming in with the Jewish holiday from now until early October. Maybe we get a little bit of volatility, a little bit of weakness. But again, it's going to be a buying opportunity, in our opinion, led by strong earnings, led by strong profit margins, led by, again, a stronger consumer. Look at those retail sales last week. We just don't see this recession. Some people talk about a recession still. We're just not seeing it. We'd still use it as a buying opportunity.
Yeah, what about corporate buybacks? I think there was a note out yesterday, record high. So not only is it, sort of individual investors putting their money to work, corporations are putting their own massive cash piles to work.
You're not kidding. Yeah, we've been seeing that a lot this year, obviously. And listen, go back in history and look. Yes, there's a point where if you buy too much, insiders buy too much, or corporations buy too much, maybe that's a peak. Maybe I'm looking at you 2021 with all those SPACs. But nonetheless, we've seen a lot of IPOs, seen a lot of buybacks. I mean, the reality, I think the answer to the question, the credit markets are still solid, right? I mean, even when we had the big pullback, the 10% pullback in early April in 2 days, credit markets are functioning just fine. So the reality, again, there's no monster under the bed. Corporations are still, there's a lot of deals. Every day you come in, there's like another AI deal out there. Deals are happening. Those are all still net positive to us.
Yeah, what's a worry for you then, Ryan? What would be?
Yeah, like I kind of mentioned a second ago.
You're paid big bucks, I hope, my friend, to worry.
Yeah, we do worry about some things. Like we just talked about, there is some complacency coming in there. There is a lot of optimism in certain pockets. We're seeing that. Maybe we could be due for some type of correction. One quick one. Just last week, everyone knows, the market's up, made a bunch of new highs. Only 2 groups outperformed last week. It was technology, communication services, right? If you look under the surface, mid caps are lower. We're not seeing, in my opinion, right now, solely the participation that you prefer to see. Maybe, again, just saying maybe we could be due for 2 to 3 weeks of some consolidation, well-deserved pullback. But bigger picture, I think the bigger worry we have is a lot of people still are worried. There's that headline in Wall Street Journal. Now it's like 1929. That's what worries me. Too many people are listening to these scary headlines, and they've missed a lot of this rally. I don't want them to miss the rest of this rally.
Is there any part of you, Ryan, maybe you heard the top of the show, that worries about all the AI spend, and what if it can't happen because, Nvidia or anybody else realizes, well, we can't make the electricity, so we actually are going to spend a little bit less, because those headlines are what's driving those stocks, which are driving the market.
No, you're right. I mean, what is it? 34% of the market is technology now. So clearly that is a potential worry. But that's one thing we've said all year, Sully. When in doubt, diversify it out, right? Have a diversified portfolio. Don't just chase the shiny objects. And look around the globe. There's a lot of opportunity, unlike the last couple of years. So have a diversified portfolio. If tech pulls back for some of those potential concerns, you'll probably do okay. Just like in April, we had that big pullback. If you had a diversified portfolio around the globe, it really wasn't nearly as bad as it felt if you're a U.S. heavy, specifically tech heavy.
So I want to show you guys my possible buys watch list here. Just some stocks that you would usually look at as far as the economy goes, and see what's going on with these companies. And what we're going to find is Whirlpool, under $80 here at this point in time. That stock continues to falter. Just can't catch a bid. And this is despite the market being right around all-time highs. You look at a stock like Nike, right? Another one you would usually look at is economy strong or not? And that one just continues to, obviously it's up a lot from the lows when it was in the 50s back, in April, but it's still in a down and out place. You look at a stock like RH, still in a very down and out place there. Is it up a lot from the lows? Yeah, sure. It was 149 at that particular time, but still, $200 is not a lot for a stock that used to be priced at $700 plus, right? Look at a stock like Target, another one you look at and say, okay, if the market was really strong, if the economy was actually really strong, the stock should be doing well. And this one just continues to seem like, today it eked out a small green gain, but gosh, look at this stock. It's been obliterated. This is a stock that a few years ago was a $250 plus stock, right? And today it's $87. And, so anyways, there's a lot of stocks, but then you look at something like a Wynn, and Wynn stock's been very, very strong. On Fast Money, they actually gave it a shout out just a bit ago, and I think they mentioned something like Wynn's up 93% from the April lows or something like that, which is an extraordinary move. But Wynn, Wynn's kind of not really the economy, right? Wynn is the top 10% of income earners of wealthy folks out there, and so that's just a different stock there. So anyways, that's something to factor in that I think is important, that everybody should be kind of thinking about and looking at. Mike Wilson.
You're so smart about physics. I'm reading how you're basing some of your calls, and you are like tackling the most difficult things to forecast. You're not just like looking at momentum and stocks maybe continuing to go up. You're trying to decide whether there's a recession risk. You're trying to decide whether, at this point, Bullard just said it, you think the recession risk is behind us and we're reaccelerating.
Yeah.
The economy is reaccelerating already.
Yeah, I think forecasting stock markets is as hard as coming up with gigawatts or gigawatts. Okay, trust me.
Well, you're not even doing stock markets. You're doing the economy and the Fed.
Yeah,
they can't do it.
Well, look, it's difficult, right? We're trying to live 6 months in the future, and I think the market does live 6 months in the future, as we've said many, many times. And our thesis for the last 2 or 3 years has been very consistent. We think we've been in a rolling recession for 3 years, and we've documented this in quite a bit of detail. The last couple of weeks, we've actually gotten more information around the job revisions, not just the big one that we got the 911,000, but also the 2-month payrolls. And we've done some pretty interesting analysis there that shows very clearly that the trough of the labor cycle was in March, April, okay? Whether you're looking at job cuts or you're looking at the payroll revisions. And that bottomed, okay, with the government recession in Doge, which is what we were waiting for. So that was all of our thesis for this year. So we feel pretty good. We have the right narrative now. The market, by the way, is our confirmation. The market figured this out at the exact same time. So that, like the old adage, trust but verify. We trust our analysis, but the market kind of verifies.
I was going to ask you, if we went through a recession, why are we at new highs? But you said it didn't happen until the recession was already over.
That's right. Well, typically, remember, Joe, when the market always bottoms during a recession. It doesn't bottom when it's over, when it's obvious to everybody. Okay. Now, the Fed's working on lagging data, like always. By the way, that's not new either. This is not an unusual feature. We saw the same thing in 2008. We saw the same thing in 2001. Okay, we documented this. So this is very apropos for how it usually works. The one thing that's missing this time, it's different than 2001 and 2008, is the Fed is actually behind the curve more than they have been in other cycles because of that lagging labor data, which we think will catch up in probably November when all those Doge employees who were let go have to file for unemployment insurance.
All right, so we're going to continue, even though we've already bottomed, we're going to continue to get some straggling bad numbers.
Absolutely, that's the way it always.
So to push back against Mike Wilson here for a moment in regards to recession, all those sorts of things, right, and how it relates to the market. Listen, the issue you run into here is if you are actually going through a recession, right, you never know where the bottom is actually. Right? You never know where the bottom is for unemployment. You never know where the bottom is for real estate, for the stock market, if you're actually going through it, right? There's no telling. No different than on the up cycles. There's no telling where the up cycle stops at. Like, it can keep going for a long time. Like, people, if you would have asked somebody 15 years ago, could you see a stock market with a 40 Shiller PE in the next 15 years? People would have said, no, what? Are you crazy? Like, the Shiller P is going to probably be in the 15 to 25 range for the next 15 years, right? And here we are with the Shiller P of 40, right? You can never know exactly where the top is on an economic cycle or the stock market or the bottom is. So if you are in a recession, you can make an argument that it could get a lot worse, right? And so, and I can tell you certainly when we were going through the great financial crisis, people thought it was going to get a lot worse. It was an ugly situation. Unemployment was around 10%, but you had some people saying it's going to 15%, 20%, those sorts of numbers, right? And it didn't know, because you never know exactly where it's going to bottom or not.
They're going to straggle in.
Interesting statistic, okay, which is the market, okay, typically bottoms a year before the unemployment rate peaks. That's typical.
Why should the Fed be cutting now then? They should be raising.
Well, because there are other reasons they're cutting. Okay, first of all, we do need to cut because in order to get a full recovery, right, the rolling recovery now, we need rates lower. One of the reasons why we've had a tepid, kind of economy in the private sector is because rates are too high for most businesses, particularly small businesses and consumers. So they do need to cut rates. The question is, how much are they going to cut? And that's why we haven't seen the full rotation yet to the early cycle, small cap, low quality parts of the market. Okay, so I believe that last week was sort of a sell the news event, because the Fed is sort of dragging its feet. They cut 25, and the market really wants or expects, or is priced for, more importantly, for something more aggressive. So we have this window now for probably the next 6 weeks or so where we think the market is at risk of this tension between the Fed being kind of behind its own curve.
By the way, I'm watching this 10-year like a hawk for the next 9 months. Do you know why? Because in roughly 9 months from now, I'm going to have to sign my name on a dotted line for a mortgage. And so my hope is, over this next 9 months, is that 10-year goes down and down and down all the way to Chinatown. I would love it if that 10-year goes high 2s, low 3s within the next 9 months. If that can happen, I'll be a happy camper.
And the bond market and the equity market is really wanting or needing now a more aggressive Fed path.
But the background, your whole overriding theme.
And hopefully the Fed funds rate 9 months from now is hopefully high 2s. That's what I'm going after.
Is it we're early cycle? Isn't early cycle
high 2s, maybe
if you're
mid 2s?
Patient for the next 6 weeks.
9 months from
Shouldn't
now.
you be buying stocks here then if we're early cycle? I mean, are you telling people right now we're early cycle and it could be the beginning of a multi-year period of rising stock prices?
It's exactly our call. We said very clearly that April was an end of a bear market. That was the Liberation Week was the final piece of bad news you typically get at the end of a major bear market. And by the way, just to be clear, the average stock was down 35% between April of 24 and April of 25. That's a proper bear market. So the new bull market began in April, and now it's evolving, and the stock market's ahead of kind of the data as it typically is. We've seen, by the way, just because small caps and low quality early cycle stocks haven't outperformed, they have gone up in absolute terms significantly. So the market is telling us that that thesis is correct for now. And the risk of that is that the Fed stays behind the curve longer than the market expects, and we have a little digestion here, which could be a meaningful correction in the next 6 weeks. We'll see how it goes. But either way, that doesn't change our thesis that the early cycle rolling recovery has begun.
I can see going against a consensus, but just about everything you just said is 180 degrees from where most people think we are.
Not the first time.
Not the first time. Well, time will tell.
That's right.
Yeah, so, I got to disagree with Mike Wilson there. Okay, listen. He views what happened in April as like the start of a new bull market. I don't. I view we started a new bull market in 2022. Now, my opinion is he doesn't view things that way. You know why? Because Mike Wilson stayed bearish. And if you've been following me on the reaction channel for the last several years, we reacted to plenty of Mike Wilson clips at the end of 2022 into 2023. I think even going into the beginning of 24, where he was just, you listen to him and he's just bear. And so, that's my opinion on why he doesn't, wants to kind of fit this narrative about a new bull market started. When I'm like, we've been in a bull market, sure, we had the severe correction, but I don't think that really ended the bull market, at least in my opinion. That was just a severe correction inside a bull market, essentially. And that sometimes you get that, right? But really, we're in almost a 3-year deep bull market now at this point in time, in my opinion. That started back in the fourth quarter of 2022, right? And now we're almost to the fourth quarter of 2025. And so we've had pullbacks along the way, corrections in that severe correction. But I still feel like we're in an overall bull cycle. And at some point in time, this bull cycle will end, right? But that will be when we get that, really kind of elongated 25 to maybe 35% fall in the S&P 500. But don't hold your breath on that. Maybe it comes in 26, maybe it comes this fall, or maybe you've got to wait several years for it to come, right? And by that time, the market could already be significantly higher. And so maybe the S&P 500 goes up another 30% from here and then falls 30% after that. And so, yeah, you got to take, if you see great deals in the market, you got to take advantage. You got to act now. You got to invest over periods of time, because, you know, you're never going to be able to call the top of the market or the bottom of the market. You just got to find great deals and buy them. Okay. Where the stock market is about to head, it's about to get very, very interesting, and very, very shortly here. Okay. Now, we are living in very strange times, extremely strange times in the money space, in the financial space right now. We have an S&P 500 that's right around 6,700. The S&P 500 has climbed over 90% the past 5 years. Incredible performance. You should have made a lot of money in the market the last few years, right? S&P 500 today, all-time highs. Meanwhile, you look at something like the consumer sentiment, which this survey has been done since the 1950s, and we are near all-time lows when it comes to consumer sentiment out there. The lowest we ever hit was actually in 2022, and before that, you got to go back to the great financial crisis. Then before that, you really have to go back to 1981, which was an economy that was plagued with massive stagflation. It was an ugly situation. You had a huge recession while you simultaneously had inflation. It was very bad. Paul Volcker had to raise interest rates to rates that honestly we've never seen even remotely close to Fed funds rate at anything, you know, in that realm ever since that time period. Essentially, you're looking at the Nasdaq up almost 27% over the past year, and the Nasdaq is at all-time highs here today. The Nasdaq has been booming. Meanwhile, in my city, Las Vegas, I was just looking at some things today, right? And it was talking about we're losing thousands of construction jobs as tourism slows and economic uncertainty remains high, according to a new report. The report from the Associated General Contractors of America showed that construction jobs were down 6.4%, which was about 7,000 jobs on a year-over-year basis here. The contractors' report comes on the heels of another report that found the Las Vegas Valley had shed 4,300 jobs from July to August, according to the Nevada Department of Employment, Training, and Rehabilitation. Okay, then you're looking at a stock like Nvidia. Nvidia's up 1,200+% over the past 5 years. New all-time high literally today. Meanwhile, you look at a stock that you would generally look at if you want to know, is the economy doing well? Are people doing well? Is this boom times? Like Whirlpool that sells appliances, and this stock's down 54% over the past 5 years. And it just hits new low after new low after new low for a stock like that, right? Meanwhile, you got a company like Palantir. It's right around and near an all-time high. We're up 2,300+% on Palantir stock. Absolutely amazing, right? Meanwhile, you look at something like Target. You would look at Target if you thought you were in a great economy or a strong economy. You would look to a company like Target and expect Target to be doing very, very well, right? No, Target stock's down 42% over the past 5 years. This stock seems like every day it just goes down. Every day it seems like Target stock just goes down and down and down, right? If you want to see this difference between the haves and have-nots, right, which is a point I'm starting to illustrate to you guys, look no different than Wynn Resorts versus Caesars. Wynn Resorts caters to who? The wealthy, the top 10%, the top 20% of income earners, of wealthy. That's who Wynn Resorts caters to. Their resorts are the highest end in Las Vegas and the highest end in Macau. And really, you know, any place that compete, they are the creme de la creme. They attract the biggest gamblers, the ones that spend, you know, will drop $500,000, will drop several $1 million on a weekend vacation. Those type of people. Caesars Entertainment, you look at their properties, they really cater to the middle class, or maybe even people that are a little under the middle class, essentially. And look at these stocks and how much they have diverged this year in 2025. Wynn stock is up over 50% this year. Meanwhile, Caesars is down over 21%. What gives? It looks like we have an economy of haves and have-nots, right? And so if you think about it, right, it seems like 80% of folks are really struggling out there, and you're either in the percent, like the 80% that's struggling, or you're in the 20% that you're like, man, this feels like the greatest of the great times, right? You either feel great right now or you feel trash right now. And there's, unfortunately, right now, there's kind of no in between. You either feel like, you know, the sky's the limit, we're going to the moon, or you're like, man, like it's a struggle out here, right? Now, this is very different, what has occurred here over the past few years, than what had traditionally, at least I'd been used to, right? I joined the workforce in 2008. Now, I joined the workforce during the great financial crisis. Horrible, right? I was fortunate to get my first job at Einstein Bagels, cleaning dishes in the back for $7.50 an hour. And then I felt like so lucky to then get a job at Walgreens shortly after that, making $8.25 an hour they started me at, right? But guess what? We were all in that together because, yeah, the jobs I had to get sucked and it was hard to get hours when I entered the workforce, right? But it wasn't like I was the only one struggling. Like the whole jobs market was a mess, right? The stock market was in a crash. So even rich people were losing millions, tens of millions, hundreds of millions, billions of dollars. It felt like we're all in this together. Like it's a struggle out here, man, but we're all in this together. You say, well, yeah, the rich people are still rich. True, but they were losing fortunes of money. Real estate was crashing. Their home prices were going down. So even if you were rich, you were going down with the ship as well, right? We're all in this together. Then as I got my first good job at Quick Trip, right? I started being able to save more money, invest more money in the market. My net worth started to grow, right? The stock market was going up. And guess what it felt like? It felt like we're all in this together. The economy's getting better. The jobs market's getting better. Businesses are doing better. The stock market's doing better, right? We're all in this together. We're all starting to do better. It was a great feeling, right? Then I fast forward a few years later, after I start my real estate marketing company, I get on YouTube. Stocks are doing very well for me, right? And this is a picture. I bought my first more expensive car, I guess we can call it. I bought a Alfa Romeo Stelvio SUV. I think that was it might have been the first new car I ever bought, or maybe the second new car I ever bought, and kind of an expensive car for me. And it was a great feeling. But it wasn't just like I was the only one doing well. It felt like everybody was doing well. It felt like the US economy was just strengthening and like everybody was just doing better, right? So it wasn't like, oh, I'm the only one that's out here like, achieving new things and like being able to have success and things like that, right? But let me be very crystal clear about this. The last 3 years, 2023 through this year, 2025, it no longer feels like we're in this together. It feels like you're either doing better than ever or you're doing bad. I don't like it at all. But that's the truth about this economy for the last several years. You're either doing amazing, which is you own stocks and you own top tier stocks, right? Or you got a lot of money in the bank and you're able to get 4%, 5% on treasuries the last few years, or high yield savings accounts, things like that, right? Or you're like, really in a struggle now at this point in time. So we have a completely different feeling and different economy and different stock market than anything we've been used to, right? And I will point you at the public account. It's the perfect example of this. Look at the public account the past 3 years. The public account has grown nearly $3 million. If we go back 3 years ago, this portfolio was just over $1 million, right? And now the portfolio is just under $4 million. So being somebody like myself, with considerable money in the market, feels amazing. Like, oh my gosh, we've made so much money. And then think about all my other portfolios. But if you haven't been in stocks the last few years, it's not a good situation, right? Now, in this video here today, there's 3 core subjects I want to speak about here. How do you join the 20%? How do you get in that club? Okay, I'll point you exactly in the right direction so you can join the 20%. Okay, number 2, what is going to happen in 2026? And that's what I want to explain to you guys in this video, because what's going to transpire in 2026, in my opinion, is we're all going to be in this together, which means there's one of 2 scenarios. We're all going to be doing a lot better in 26, or we're all going to be doing a lot worse in 2026. And I'm going to lay that all out for you guys and how that works. So you guys, I'm already thinking about 26 at this point in time. I understand we're still in 2025. It's the end of September 2025. I'm already on 26. I'm going to explain all that in this video here today. This is a beast video, by the way, okay? And the third thing we're going to get into is what is about to happen in the market from here, okay? Because we have a whole lot of drama coming this fall and winter I need to run you guys through so you're prepared on what's going on here in the shorter term and over the longer term as well, okay? I hope you guys enjoy this beast of video. This took, I think I prepped this video for like 4, 5, 6 hours. It was a long period of time. So there's one thing and one thing only I need from you guys. If you could please, if you haven't done so already, just hit the like button on this video. If you could just make that little thumbs up button glow, that would mean the world to me. Additionally, if you want to be subscribed here to the channel, you can certainly subscribe. We are at 800 and something thousand subscribers. I appreciate every single person that joins me video in video out. Okay, and if you want to see more of my videos, make sure you subscribe to the channel. Right? Alrighty. So let's get rolling here. Okay, that kid right there. I understand he might not look like the most intelligent boy. Okay, but listen, that kid right there, he realized something. When I was in college, I realized something, okay? I went to community college, And I started taking a lot of business courses, finance courses, accounting courses, took 3 levels of accounting, and just anything in the realm of money. And I found that, like, I was just like, oh my gosh, like, I love this. Like this is what I was meant for. Like, oh my gosh, like, it was like my eyes got open. Like, holy smokes, like, I love this stuff, right? Like, I always hated school. And then I go to college and I start taking all these business courses and accounting and all these subjects in relation to money, psychology, even things like that. And I was like, oh my gosh, like, this is amazing, right? But that kid right there, he realized something. And what I realized is in the United States, you have a large percentage of people that basically are in poverty, right? Food stamps. I've been on it as well, in my very early childhood. And, even when I was I think it was when I was like 18, 19, I had food stamps for a little while. So I've been part of that program as well, right? But there's a large percentage of people that are on food stamps or need some sort of government assistance, right? And so it's tens of millions of Americans, right? Now, additionally, once you go out of kind of the poverty stage, you realize still the majority of people are kind of almost in their impoverished state where they're living paycheck to paycheck, right? And over the years, this number has just gotten bigger and bigger and bigger, it seems. But even when this kid was realizing this whole game and how to play the game, even back then, it was still a large percentage of people were in poverty, or essentially they were in a situation where they were living paycheck to paycheck. The difference now is it's gotten even bigger, especially in terms of people living paycheck to paycheck. It's an extreme amount now at this point in time. So basically, the way I would put it to you like this is around 8 out of 10 Americans are either in a situation where they're in poverty, they need government assistance, government help, or they're literally living paycheck to paycheck. And whatever comes in that door each week or every 2 weeks or every month or however often they get paid, right? Or if they have a business as well, it's all going right back out. There's nothing left to show for it. There's nothing left to say, you know what, I'm saving up so I can go make a down payment on a house. There's nothing left to say, you know what, I'm saving up so I can put more money in the stocks. And it's a huge percentage of folks out there, right? Now in boxing, there's really 2 steps to being a great boxer. You don't want to know what they are? Hit the other person as much as possible and get hit as little as possible, right? Now to do that, there's a whole bunch of steps you have to take to do that. But at the end of the day, like, that's how you win a fight. Hit the other person as much as possible, get hit as little as possible, and you're going to win a whole lot of fights that way, right? In the money game, it's a 2-step process as well. It's a 2-step process. Make as much money as possible and live under your means. You do those 2 things, you're going to win a whole lot of fights. No different than you punch the other guy a lot more than you get punched. You're going to do very well in boxing. And in money, make as much money as possible, live under your means. And you got to always do that. That doesn't mean you never spend any money. That doesn't mean you don't ever go out there and buy something, go out to dinner or something like that, right? But you got to live under your means. Throughout my entire financial life, I've always lived under my means. To this day, with all the net worth I have, I still live so far under my means, it's not even funny. I go buy a Ferrari, I buy like an entry-level Ferrari. I'm not going to buy a freaking Enzo, okay? And so I've always lived under my means, and that's allowed me to invest and invest and invest heavily. That's the trick. But a lot of people, what they do is whatever amount of money they got coming in from their business or from their job, you know what they do with it? They have lifestyle inflation that's right up to that number. So if after taxes they have $4,000 a month, they end up having lifestyle inflation that's right up to $4,000 a month. They'll max out whatever rent they can afford or mortgage on a house, right? They'll max out whatever car they can afford. And next thing you know, there's nothing left to show for it. And then if they have any expense that comes up, you know what they have to do? Take on credit card debt at 25% interest rates. It's a sad story, but it is the reality for the far majority of individuals out there, even in a country as rich, as filthy rich as the United States of America. We know this country is loaded with money. There is no shortage of money in the United States of America. You want to be a millionaire in the United States of America? Dude, you can be a millionaire in the United States of America. There's so many business opportunities out there. If you want to work hard, you got the right strategy, right? And you're willing to accept the risk that comes along with that and sometimes make mistakes. There's more money than you could ever dream out here in the United States of America. But just because our country is filthy rich and has a lot of people that you can make a lot of money from, does not mean It does not mean that everybody's doing great. The truth is most people are in poverty or they're basically they're in a paycheck to paycheck situation, right? What you need to do is you need to invest as much as possible every week or every 2 weeks. You should have, like every single person watching this video, let me ask you a question. Are you in a financial position to invest bare minimum $600 a month in the market every month? If the answer is no, we got to figure out that income and expense problem. We've got to get that income up or we got to get the expenses down. We got to do something. And for every person watching this video that you can do over $1,000 a month in your investment accounts, you're doing well for yourself. Pat yourself on the back. You got yourself in a great place. Just continue that through and you're going to be looking really dang good. And what you do with that money is you have many options. You can invest in the S&P 500, right? Which is just pretty common, like an index fund. You could invest in the QQQ. You could invest in something like small caps, IWM. You could invest in an index that tracks like the world, right? Or you can invest in individual stocks like I do. Now, each of these has upside and downside that you got to understand. And not a lot of people talk about it. They only talk about the upside in regards to these and the downside in regards to these. So like, for instance, individual stocks, a lot of people just talk about the downside. They never talk about the upside. I'll take you right through the upside and downside. The S&P 500, you want me to take you through the upside? Well, S&P 500 has done very well over time. You can usually get about 8% per year on average. Now, over the past decade or two, you've actually done better than 8% a year, right? So that's the good side. The bad side of the S&P 500 is it is heavily concentrated right at the top, which, you know, might look at it as not a bad thing because it's the biggest stocks in the market. But let me be very crystal clear. If Apple has, trouble growing revenue in future years, Nvidia, Microsoft, Amazon, some of those sorts of stocks, that index will get hammered much harder than we've actually seen historically, and actually could underperform significantly. So you're basically kind of like hoping that Nvidia, Apple, Amazon, all the big companies do phenomenal because the small ones are not enough to make up the ground. Now that we're in a time period. Remember when I talked about the haves and have-nots of people? We're in the haves and have-nots of corporations. And now, if you're talking about the S&P 500, you're completely tied to a few of the very best companies. And if those companies have a misstep, that index is going to get hammered for years, right? The QQQ, that's the same exact story as S&P 500, but just more extreme. So the QQQ has been more extreme, like upside performer over the past 10, 15 years, but it comes with even more risk because that one's even more concentrated into the biggest tech stocks. So if those big tech stocks all of a sudden start to run in some trouble in 26 or 27, the Qs are going to get hammered. Then there's IWM. IWM, you could look at that and you could say small cap stocks, those are ones that have underperformed for years. They're due to have a strong 5-10 year span, right? True. But the small cap stocks, a lot of people don't want to invest in those. They look at it as not even an investable category anymore. They're just not interested in small caps, which could make them continue to underperform for quite a while, right? That's a risk that comes with IWM. Additionally, if the economy was to get worse, you could say, well, the biggest companies that are maybe in the Qs and SP 500, they're going to get through it just fine because they have such profitable business models. They're not cutting it close. Like they have fortress balance sheets. A lot of companies in IWM don't have fortress balance sheets. And a lot of them are cutting it close. Their margins are tight. And if things were to go south, they could get hit significantly. So that's a risk that comes with IWM. Worldwide index, you say, well, that's so diversified, right? Might come with less risk because, we're talking about stocks all over the world. Well, there's big risks that also comes with the world index that people don't talk about. And that risk is a lot of countries are going to not do very well over time, right? And you're getting exposed to a lot of countries that, just you think the United States government's a mess. Just telling you, like around the world, we got a lot messier governments in the United States of America, which are going to hold back a lot of countries. Additionally, you want to talk about getting in just massive amounts of underperforming stocks. That's a worldwide index, right? And that's why the worldwide indexes have had trouble even keeping up with the S&P 500, never mind the Qs. So then you say individual stocks. Individual stocks, we always talk about the risk in regards to individual stocks. Everybody knows it, right? You're going to be concentrated into probably 10 to 25 positions, which means if you get a few of those wrong, you're in a lot of trouble, right? On the flip side, you get it right and you get a Palantir and you made life-changing money. You get in a Tesla stock, like when I got in Tesla stock back in 2019, you made life-changing money. You got into ELF stock back in the day. When I got into ELF stock, you made life-changing money. You bought Monster stock back in the day. When I bought Monster stock, that was before I was even on YouTube, you made life-changing money. So there's a lot of stocks that can change your life for the positive, but if you pick the wrong ones, you're going to end up in a lot of trouble in this game, right? But they all come with risk, right? Me personally, I love individual stocks because I'm willing to do the research work. I know what I'm doing in the market, right? And additionally, like, I would rather be in 15, 20, 25 of the very best companies I can find rather than in 500 companies where 200 of them are not good companies that don't have exciting next, 5, 10 years ahead, right? Where another 200 of those companies in that S&P 500 are like meh companies. And then I got 100 that are actually good or great. And of that 100 that's good or great, I probably only have 50 that are really in the great category, and I probably only have 20 that are really that extraordinary opportunities. So that's just something to kind of consider there, right? Now, to illustrate how important it is for how much money you want to put in, essentially, I said, let's play around with Gemini a little bit. I said, if you invest $200 a week and you receive 10% annual returns for 25 years, you would have $1.1 million after 25 years with a very modest amount of $200 a week. That's not a lot of money. That's only $800 a month, basically, right? Not a lot of money, and you're still at $1.1 million. Now, I said, let's amp it up a little bit to kind of illustrate how important the amount of money is. I said, what if you did $500 a week, right? Which is about, we can call it a little over, $2,000 a month or so, roughly, right? And you get a 10% annual return for 25 years. Now we're talking about you're at nearly $3 million 25 years from now. I said, what if you do $750 a week at a 10% return for 25 years? Now you're at $4.3 million. And then I said, okay, what if you got a 14% return? Because the return profile, you got to understand, matters almost as much as how much money you put in the time. Look at this. If we just change it to a 14% return, just a few percentage points higher, suddenly you're at nearly $9 million. Life-changing money. That's interesting. I said, what if we change it to an 18% return? You're over $19 million. A few percentages on the upward swing above a 10% return. And we're talking about it's multi-millions of dollars of difference, right? The difference between a 14% return and an 18% return is over $10 million from just 4 percentage points. So when you wonder, like, why did I do it, man? Why did I put in all the work? Why did I listen to those conference calls at 1 a.m.? This is why. Because we're not talking about this as small money up for grabs. We're talking this is millions and tens of millions of dollars up for grabs, right? We got on the boxing subject earlier, like, why was Mayweather willing to put his body through hell, run miles and miles and miles and go through those grueling training sessions he used to do? Because he understood I could make tens of millions of dollars in a 45-minute fight. Sounds pretty interesting, right? This is why we do it, folks. This is why we do it. Now, look at this. If now we take that same 18% return, $750 a week, right? So the first part's the same exact, but I said, let's do it over 35 years. Look at the money difference. Now we're talking about 9 figures in stocks. $116 million. A real player. And that's not even on a crazy amount of money. It's like $750 a week. It's not a crazy amount. I guarantee you there's some people watching this video right now that are like, $750, that's it? A week? You do that over 35 years at an 18% return, you're at $116 million. Yes, this is why we play this game. Because the difference is it's not small potatoes here, folks. This isn't like the difference between we're 50 years old and, we have either $80,000 net worth or $90,000 net worth. No. This is like you're 50 years old and, you've got 20 million in stocks or you got like $200,000 in stocks. Like the amounts of money are ridiculously different. So the moral of this story is 3 parts. Invest as much money as possible. Number 2, get as good of returns as possible over time. And number 3, start as young as you possibly can. There's a reason I started this game when I started back when I was like 18, 19 years old, because I was like, dang, man, like when you let compounding do the work for you, it really starts to add up. And I mean, sometimes, I'll hear from people that are like getting in this game even before 18. Like their parents set up an account, some sort of custodial account, and they'll start investing at like 14, 15, 16 years old when they're still in like high school. Good for them. Like they're just like, it's just math. They're just going to compound for even longer. And also your education, because remember, all this stuff it compounds. So the education portion compounds as well. You get to, like, your brain is no different than an artificial intelligence engine. It just like, it learns from all this, right? It adapts. You can see, like, there's, stocks that I'm able to avoid nowadays just because I've been in the market 17 years. I'm like, no, that's a trap. That's a trap. That's a trap, right? And there's other ones I can see as an opportunity. I'm like, oh my gosh, like, this is a massive opportunity. This reminds me of this stock that did these same things. And you put the pieces of puzzle together, right? So time in, it matters significantly. Now, additionally, you want to get scared a little bit. I said, what if you do a 4% return, right? 4% return, that's $750 a week, 25 years, you get $1.6 million in your portfolio, right? So you can screw this game. If you screw this game up and you don't know what you're doing in the market, you get really poor returns, it changes your return profile immensely. And a 4% annual return would be awful. But there's some people that would get that over time because they don't know what they're doing, right? And remember, we're talking this is 25 years from now. $1.6 million 25 years from now is not what $1.6 million is today. Think about $1.6 million 25 years ago. $1.6 million 25 years ago, people would look at you as rich. They're like, oh man, you're wealthy. You're doing well for yourself. If you had $1.6 million portfolio 25 years ago, that's what people would say. So $1.6 million portfolio today, it's like, oh, you're doing well for yourself. Good for you. It's not rich. Not $1.6 million portfolio. Not today. You're doing well for yourself. There's a big difference. Imagine 25 years from now with all the money printing. Imagine what the U.S. debt's, oh my gosh, is going to be 25 years from now. My brain can't even comprehend that. It's just ridiculous. I don't even think an AI program could comprehend that, right? You know what $1.6 million is going to be 25 years from now? They're going to be looking at you and be like, oh, good, you're starting up a portfolio, huh? That's what they're going to look at you, 1.6 million 25 years from now. Oh, that's a good starter portfolio. Good for you. Crazy, man. So in order to understand this game on a higher level, you better understand income statements, balance sheets. You've got to perform SWOT analysis in your companies, understand the strengths, weaknesses, opportunities, or threats. How do you figure all that out? Research. Read the 10Ks. Do all your research in regards to these companies, right? Listen to conference calls. And when it comes to investing in stocks, GVD, growth, value, dividends. This is how I'm teaching. I'm just giving you guys game right now. I'm just giving you gems one after another here, okay? And through that, you can begin to actually figure out how to play this game on a high level and invest in the companies that are quality companies. If you don't understand these sorts of things, you could set yourself up into a situation where you actually get awful returns over time, which then is going to affect your net worth considerably over the next 10, 20, 30, 40 years, right? No, you got to perform projections for a company. You have to. 1000xstocks.com. My favorite feature on it is a projections feature. And what we do on 1000x is plug in what analysts are expecting that company to do for revenue, for net income margins for that particular year, right? And then I go ahead and adjust my stuff. Now, how do I know all my numbers, right? Well, because I research the companies. And so I look at past growth rates, I look at what they have coming, and then I'm able to figure out rough ranges of like, okay, on a bullish case, this company could probably grow revenue over the next 4 years at this sort of clip. And they could grow net income at this sort of clip, right? And I do that for my bull case. And then I say a PE ratio that kind of makes sense for this company would be somewhere in this ballpark, right? Then I do my base cases, which was what I expect. And then I do a bear case. So let's say things go much worse than I anticipate. Run my bear case. We do all that on 1000xstocks.com. This is what you got to do. If you don't do this on 1000x, you got to be building out your own spreadsheets on your computer or your laptop or whatever. So you've got to do it, man. Like there's just no other way around it, because otherwise you cannot, if you're not running projections, if you're not running a bear case, base case, and bull case on stocks, right? If you're not doing that, you are setting yourself up for failure. You have to be anticipating, what if things go how I expect them to go? What if things go better than I expect? What if things go worse than I expect? And you've got to consider all three scenarios. If you're not considering all three scenarios, you're lost in this game. Then you're more gambling money around. You've got to be able to run those numbers, say, okay, this is probably a fair PE, and then you've got to be able to say, okay, this gives me a compounded annual growth rate of likely here. And if you can run a base case on a company, and you get a compound annual growth rate that looks like, 15, 20, 25%, that's pretty dang good, right? No, you could always be wrong, and sometimes that's going to happen. That's what we call the cost of doing business. It's the cost of doing business. You're never going to bat 100%. There's no one in the stock market game that ever batted 100%. You're never going to get every single stock right. There's investments I've made in the last few years that I'll lose money on. There's investments I'll make this year, next year I'll lose money on. It's fine. It's the cost of doing business. As long as the investment returns far exceeding anything I can get in the SP 500, that's all that matters. So what, I get a stock wrong here or there, it's fine. That's the cost of doing business. No different if you're running a business, right? Amazon's running a business. They invest $200 million into some side project that they're like, this might be the next big thing. And then it's not, and they got to shut the program down. They spend $200 million on it. Cost of doing business. Cost of doing business. But you got to be performing this stuff. If you're not, then you could set yourself up for a lot of mistakes. A lot of mistakes year after year after year. It's one thing to have one bad year, right? It's another if you have 5 bad years, 10 bad years, right? I had a really bad year in 2022, but if you look at the years prior to that, it's doing amazing. Look at ever since 2022, doing amazing. So sometimes you're going to have one of those years that, man, it catches you off guard. You get hit, you get hammered. But you got to come back from that. You can't just imagine if I just got hammered in 22 and I was like, oh, that's it, I'm done. No, got to fight back. Got to fight back. Got to fight back. Got to fight back. And we did, and look at it now, right? Public count, just over 1 million back in 2022. Now we are almost $4 million deep on the public count. Unbelievable, right? Now I can help you guys with all this sort of stuff that you need to know. That is my private stock group. That is what I do in there. I have all these course curriculums to teach you all this game. So you hopefully can make as educated decisions as possible. I teach you this whole game. Everything I've learned in the past 17 years, you can download it from my brain to your brain. That's the pinned comment down there. Click on that, fill out a form. Let's see if we can get you access to that. Access to 1000xstocks.com so you can run your projections, so you can figure out, am I getting ripped off on a stock? Am I getting a great deal on a stock, right? All that good stuff. That will be the pinned comment down there. And then once you join us in there, we will send you your Steel membership cards, one for 1000x, and then we'll send you your Steel membership card for the private stock group as well. Okay, let's get some help. Next up here, why are we all going to be in this together again in 2026? Let me explain that here in this video. Okay, so 2026 is the year where Trump has to accept full responsibility of the economy, essentially, right? 2025, your first year as a president, you can kind of cast it off as like, I'm cleaning up the mess from the last guy, right? And that works. But once you've been in a while, right, and once you hit that second year in office, you can't blame it on the last guy anymore. I mean, you could, but, no one's going to buy it other than like your most loyal followers, right? So 2026 is the first year of the full-blown Trump economy, and it could go great, right? We got a lot of his, tax changes and things like that could be seen as very helpful. And so maybe it goes great in 26. Or maybe it goes the other way, right? And so the way I see things getting is either the whole economy gets better and the stock market does pretty well as well, or I think we get a market crash in 26. If, let's say, the year goes along in 26 and people become less confident in the economy, then that's going to be bad because they're going to be saying Trump's still in office for another 3 years and he's got an economy that's in rough shape, right? So that'd be no bueno situation. So my opinion is we're either all going to do bad in 26 or we're all going to do good in 26, where the stock market holds up well and the economy in general starts strengthening, the jobs market starts strengthening, and there's more of the consumer confidence starts to improve, business sentiment starts to improve, all those sorts of things, right? Now, we have an S&P 500 P ratio right now that is very high. And honestly, if you look at the past 20 years, this is the highest P ratio we've had, not coming out of a recession, essentially. Because you can look at right here, kind of in this 21 time frame, late 2020 time frame. Yeah, the PE ratio was higher than it is right now, but that was coming out of Rona, like massive recession, right? Worldwide economy closing. And then here, obviously, the PE ratio went insane, but that was coming out of the great financial crisis. So a bunch of companies had horrible earnings end of 08 into the beginning of 09. Okay, so that's why the PE went so insane during that kind of 2009 timeframe. So this is a period, like, the government at least hasn't said we're in a recession, right? The Bidens didn't say we're in a recession. The Trump folks haven't said we're in a recession, right? No one ever wants to admit that, but who knows if we can trust the government data. Oh, I digress in regards to that whole situation, right? But the moral of the story is, like, there's been no, like, recession confirmed from the government like there was during this time period and that time period, right? So, it's a weird time where we got PE ratios extremely high and we're not coming out of a recession, which is, adds this strange element we have in this market and why things could get very crazy very quickly, right? Now, if you look back to the great financial crisis, right? We go back to summer 07. Summer 07 was kind of the last time period, the last hurrah of the economy before the great financial crisis. And as you got deeper into 2007, you started to get some glimmers about that, oh boy, maybe the financial markets, maybe the economy is not in the best place. And then as you went throughout 2008, it became more obvious. And by the time you were into 2009, it was everybody and their grandma knew, right? So if you look, we had a PE ratio back then of summer 07, right, before things went off the rails, of about 18. Now, right now, we're at a PE ratio of 31. So you got to say, like, we had a fall in the stock market of 50% with a PE ratio of 18. So if you don't think we couldn't have the stock market get slammed when you had a PE ratio of 31, you could for sure get a stock market slam to happen, right? No, if you look at forward P, which I always like forward P better, I think, my opinion is I want to look through the windshield, not through the back window of the car if I'm driving, right? So forward P matters even more to me. And if you look at forward P, we're at almost a 24, which is certainly high for the S&P 500. There's no debating that. Like, look at the last 20 years roughly, or at least the last 17, 18 years in the financial markets. It's pretty obvious, like, we're at a high forward P as well. But it doesn't look as extreme as the regular P ratio, right? So we're high, but we're not out of control. But I do got to caution people, if we melt this market up here for this next bit of time, we're going to end up in a situation where the forward P is kind of out of control, just to be quite frank, right? And so it kind of feels like you're climbing a mountain and you're like getting close to the top. Maybe you're not quite there, but you're getting close. And it feels like, okay, it's time to go down the mountain, right? It's getting much, much closer to that at this point in time. The feeling it has in the market, at least from kind of my perspective, right? Now, there's been a thing I've been waiting for. I've been waiting for this to happen. I've been waiting for investors to start going really bullish. When I say really bullish, I'm talking about they're much more bullish than they usually are. And just last week, the first time, in a long time, we had investors actually go very bullish. Last week, we had almost 42% of investors in the AI investor sentiment go bullish. That's versus a historical average of 37.5%. Now, we still have a lot of people bearish, but the more we get folks over to this bullish side, the more convinced I'll become that we're going to have a problem coming down the road here, okay? So the more you get, it seems like you get everybody over to the bull side, that's the more you know, okay, we got trouble brewing here essentially. Now, if you look, a great time to buy stocks is when it seems like everybody's bearish. When everybody's bearish, great time to buy stocks. So for instance, look at this survey, and this is why I track this survey. Like literally, I look at the AI investor sentiment numbers like every single week, because it's going to give you a pretty good understanding about like when you should be loading the boat on stocks and when you should be laying back a bit. Look at this. If we want to talk about the 1 year bearish high, was the week of April 2nd, 2025. Guess when I was loading the boat on stocks? That beginning of April, I was loading the boat. Right? And even at the very end of March, but especially into that first little bit of April, I was loading the boat on stocks. What a great time to buy. Almost 62% of investors were bearish on the market the next 6 months. Boy, were they wrong. Like, oh my gosh, like what it should have been 62% of people are bullish on the stock market the next 6 months. And it was an embarrassingly low number on how many people were bullish. I think only like 20% or maybe even less than 20% of investors were bullish on the market the next 6 months. Guess what happened in the stock market the next 6 months? It went to the moon. It went to the moon. The NASDAQ exploded higher. The S&P 500 exploded higher. We're sitting at by far and away all-time highs. And yet only about 20% of investors during this time period 6 months ago were bullish. Isn't that incredible, right? So the moral of the story, the more bullish people get over here, the more you got to start to be like worried about, okay, there's going to be downside coming here. But to get your timing perfect is tough. You could be a few weeks off, you could be a few months off. But the more bullish people get, the more you know you're probably into some trouble. And the more insane bearish get, you better be loading that boat, right? So 2026 is an exciting year in my opinion, because we're all going to finally be in this together, right? And I can't wait. Even if that means we got to crash the market, I can't wait, because I don't like the feeling it's been in the last few years. I don't like the feeling of like, there's a few people doing well and like everybody, like as an American, as like somebody that wants to see everybody do well, I want to see everybody do well. I don't care if you're a Republican, if you're a Democrat, if you live in California, if you live in New York, or if you live in Alabama, or if you live in Louisiana, or if you live in Nevada. I don't care. If I want you to do well. And to even go to a greater extent, I want everybody in the world to do well, right? I want everybody to do well. I don't get any feeling of validation or good feelings that like, oh, I'm doing well and everybody else is doing horrible. That's not a good feeling. That's not a good feeling at all. It's like saying, you know, oh, let me see if I can lift a weight heavier than a 5-year-old could lift. Okay, you gonna get any like enjoyment out of that? I don't think so, right? Because you're not like with real competition. I love to feel like everybody's doing well, right? Like that's a great feeling for me. And so my hope is we get into that sort of situation where everybody's doing good, everybody's doing better, right? We'll see, but it's going to be the year, in my opinion, where we all come together. It's just a question of, do we all come together where the market crashes and the rich start getting hit too, and it feels bad even if you're wealthy? Or my like the ideal situation would be market does fine and the average person starts doing a lot better, right? That would be the ideal situation, but we'll see. But it's the year where we all come together, at least in my opinion, in regards to that, right? Okay, so next up, we got to talk about what happens in the market from here, okay? Well, some significant news came out here today. Now, when you look at this news, at first you think it's very, very bullish. You got to always look deeper in the stock market. You got to always look deeper. It's way deeper than you kind of realize on surface level. So, here today, the news breaks, Nvidia to invest $100 billion in OpenAI, right? And Nvidia stock explodes higher. People are like, yes, Nvidia, let's go, baby. Like, this is great news, obviously, in the short term, because this means OpenAI, what's OpenAI going to do with that money? They're going to spend fortunes of that money right back on Nvidia chips, right? So, at surface level, you think this is good news, right? But you dig a little deeper, and if you look at the string of announcements out of Nvidia over this last bit of time, it's a lot of questionable things where they're making these investments into companies and doing these sorts of deals. You look more into the nitty gritty of these deals, and it's starting to feel like Nvidia is almost trying to prop up their own market, which isn't a bad strategy in the short term. Why not? Because think about it. They invest money into this company, they take this company's chips off their hands to use them for themselves, all this sort of stuff, right? That then they're able to show like, oh, demand's still really high for our chips. They're able to get great margins. They can even potentially put themselves in a little bit of a monopoly type market share, where if you invest $100 billion in a company, maybe they're going to feel like they have to buy your chips and nothing else, right? So there's questionable things that are going on there that maybe this administration won't look into, but future administrations will look into, and there will be a price to pay for this. But that's a story for years from now. But you know, I'm laying out things that are coming in 5 years from now, just so you guys know as far as all that game goes, okay? But this is like, oh, this is so bullish in the short term, but I'm just telling you, it shows to me like there's actually problems in the cycle. Because why is OpenAI not getting this $100 billion investment from somebody else? Why they got to get it from Nvidia, the one who's benefited the most from this whole situation? Strange. Same thing with these other companies and a lot of these other deals that are going on out there. Strange. Very, very strange. It feels to me like, you know, this is the type of stuff you start doing when the cycle's starting to slow down a bit and you're like, crap, man, like we got to comp against these insanely tough comps, and we've got to still show, like people are still expecting Nvidia to show 30, 40, 50% growth rates next year. So if you're going to, you know, you've got a brutal year of comps ahead and people are expecting 30 to 50% type revenue growth, you've got to come in with rabbits out of a hat. But when you're at that stage, that's a dangerous stage to be in, right? I'm sure you guys might have seen some memes out there today in regards to this deal. I don't know how, in the market people are, but if you're into this, you've seen some of this sort of stuff, right? Nvidia investing $100 billion in OpenAI in order for OpenAI to buy more chips from Nvidia. Gotta love it, right? I like this one out of Mav here. OpenAI buys $100 billion in Nvidia chips. Nvidia buys $100 billion of OpenAI. OpenAI buys $100 billion of Nvidia chips, and the money's just going around the washing machine there, like perfect. And yeah, it's starting to get sus. It's starting to get sus, folks. Very, very sus, right? Now, additionally, if you look at the VIX, in Nvidia, we had to talk about that at the top here, of this portion of the video, because Nvidia, what's the stock that's been the shining light of the stock market the last several years? It's been Nvidia. So if you're talking about you're getting later stages in regards to this Nvidia cycle, right? And you're maybe at that last stage, which is Nvidia's trying to prop up the market and doing whatever they got to do, which is a debate, right? You can make a debate that maybe they're not doing that, but if they are doing that, you're late stage in the cycle, which means 27 numbers. Good luck. Good luck for 27 numbers for Nvidia, if that's the case, right? Now, when it comes to VIX, we have something very interesting going on here, okay? VIX popped over 4% today. Now, strange when you start to see the VIX pop and the stock market's going up. It's not uncommon to see the VIX pop when the stock market's going down. That's normal. That's very, very normal for, look at what happened to the VIX in 2022. Look at what happened to the VIX in, this year when all the, Liberation Day drama was going on. Look what happened to the VIX. VIX spiked massive, right? And by the way, anytime the VIX spikes to 40, 50, load the boat. Load the boat, man. Load the boat. But this feels like some individuals out there are starting to brace for something coming here down the road, and likely within the next few weeks. If you start to see the VIX pop when the market's going up, that should surprise you. It should be like, something's going on here, right? Now, remember what I told you guys this year is reminding me so much of 2018. It's reminding me so much of 2018. It's not even funny. And in 2018, guess what happened? The market peaked the first week of October. And then it got rough. We had our first major downtrend. People thought that was it, right? The market started to come back, all for a bigger downtrend. Market has started to come back. Oh, it's all over. That was it. Even a bigger downtrend. Market started to come back. Oh, we're coming back. That was it. Third time's a charm. Bang, bang, bang. Boom, boom, boom. Straight down all the way to Chinatown. Ugly, right? Keep that in mind. That is something that could happen this year. Now, there's a potential what happens this year, right? Which I wouldn't be surprised at this at all. Maybe we do have fireworks this fall and into winter, right? But maybe it's much more mundane than what happened in 2018. That's a possibility. Because remember, the drama we had earlier this year was way more extreme than what happened in 2018. 2018, you got the market to get hammered earlier in the year, right? But it wasn't nearly as extreme as what happened this year. So it's a potential that maybe the market gets hit 10%, 12%, 14%, but it's not as extreme as this. Because remember, this time period, I think the Qs went down peak to trough. I think it was like a 30% move. It was a big move. It was a very big move. I can't remember the specific number off the top of my head, but it was extreme, and it was stocks getting slammed. Like there was Nvidia, I think fell like 40, 50% quick. Apple fell like 30% quick. Like it was just devastation. Like Amazon stock was getting almost everything was getting hammered. And now there's also a case to be made. Maybe it's worse. That's something you got to consider. You had the drama earlier this year, which is what you had in 2018, but that was more extreme. So you could say, well, if you had a more extreme early year drama, like you did 2018, and let's say this is another 2018 type year, maybe this fall, winter, it's even more drama, even more downside than what we had in 2018. Dude, no one's ready for that. I'm telling you, 2018, trust me, I went through that market. That was a brutal fall, man. It was a brutal fall. And the reason it was so brutal is you didn't have anything that was like at least Roni, it was like, okay, there's a once in a year, 100-year health event we have. The whole worldwide economy shut down. So when the stock market went down the way it went down, people were able to understand, like, okay, like I get it, right? 2022, Even that market, that was a tough market to go through. I think NASDAQ fell 37% peak to trough from where it peaked at in Q4 21 to where it troughed at Q4 2022. I think it was a 37% move down for the NASDAQ, okay? We could understand that. Like, the Fed was raising interest rates at a ridiculously rapid clip. Inflation was completely out of control. It was what it was. Like, you could understand it. But 2018 was a tough one because people are like, why is the market going down like this? They're like, yeah, tariff this, tax this. Yeah, if Trump wants the Fed to lower faster and they're not lowering fast enough. Like, those are painful ones to go through. Those are scary ones to go through, right? There wasn't like there was a confirmed recession, like, oh, the economy is in a big going into massive recession in 2019. No, it never happened. Never happened. The economy was just fine in 2019, right? And actually 2020 was going to set up for probably a pretty good year for the economy, right? But then obviously Rona happened and the rest is history, right? Now, I posted this on my X page here today. I'm not sure how many of you guys use X, but if you ever use X and you want to follow me on there, I post stuff almost daily on kind of thoughts about the market or thoughts about stocks or just a bunch of different stuff, okay? Now, and views have been blowing up in regards to my X. It's been pretty extreme in regards to the impressions these are starting to get, right? But I posted this yesterday. I said I would put the odds of a 10% plus NASDAQ pull down over the fall and winter at about 75%. And that's how I feel. I feel like, probably about a 25% chance we don't have a pull down and we just keep hitting new highs and, maybe the market flatlines here and there, but we just kind of keep moving up, right? But I think it was about a 75% probability where we get like a 10% plus pull down on the NASDAQ this fall or winter, right? Now, additionally, I said the more we melt up over the next 1 to 2 weeks, is the higher probability I need to come in with hedges likely first week of October, but let's see how things unfold the next 5 trading days. So yeah, if we just keep going kind of risk on, we see investors just kind of continue to, show a lot of positive momentum in regards to sentiment and whatnot out there. Like, I might come in and do some hedges that first week of October to hedge a public account. Now I could do it like I could do like a $50,000 hedge, just boom, right off the bat. Or what I could do, let's say we continue to melt up here. I could come in that first week of October and I could put on a $20,000 hedge and then come in November, first week of November, do another $20,000 hedge for 26 and then come in December and do one last $20,000 hedge for my portfolio. So I'm protected like $60,000 going into 2026. Now that would be in puts. That's a significant amount to risk, but for a portfolio that's nearly 4 million, it's not a significant amount. And so, just understand if the market really did go south, like those puts could appreciate to $120,000 and maybe even upwards of $200,000 if the market really went south in the fall and winter. So do keep that in mind, right? Then on the other side, you say if the market could just keep flatlining or even drift up, right? Well, the $60,000 is wasted, which, that's the cost of doing business. It's part of the risk, right? And so $60,000 thrown out the window, but, if the market keeps drifting higher, like, maybe the public count goes up another $600,000. And so I'm like, I wasted $60,000 on hedges, but I made $600,000 on longs. It's okay. It's okay. You gotta know how to play this game on both sides, right? A couple of video guys you might want to really enjoy, because I'm going to keep buying the market regardless of all the drama. I buy every single week. There's certain time periods I'm plowing money in the market. Right now is not one of those times, but I am still buying every single week. Back in the springtime, plow money into the market. That was the steal deals of the century. We get a nice pull down in this market in the fall and winter. Get ready. Get ready. It's going to be time to deploy heavily, right? But I still buy regardless every single week. I'll be buying in the Patreon portfolio this week, public account, private portfolios as well. I do every single week with consistent amounts of money, right? Patreon portfolio, I buy $250 a week. Public account, I buy $500 a week minimum. And then my private portfolios is an undisclosed amount, but every single week, right? I just don't come in with the fortress of money. That's when the market's really drama times, right? But a couple of video guys you might really enjoy here. 2 stocks I'll buy nonstop the next 90 days. I came out with that video about 6 days ago that has 125,000 views. You might want to check that one out. And in this video, 7 stocks you must buy before 2026. That has 140,000 views so far. You might want to check that video out. That's definitely one I think you will enjoy thoroughly, okay? I appreciate everybody for joining me. This was a beast video. You'll be flipping my flapjacks. Nearly 55 minutes deep. Are you nearly 55 minutes deep in this video? Oh my gosh, okay. Whew, what a beast that was. I hope you guys really enjoyed this. I hope you got so much value from it. I hope you're subscribed to the channel. I hope you smash the thumbs up button because, man, Geez, I almost lost my voice. I need to drink something, okay? My private stock group, private wealth group, you want access to that. Click the pinned comment down there. That can help you out in a tremendous way. It doesn't matter if you're somebody that's been watching me for 6 months, learning under me. It doesn't matter if you've been watching my content for 6 years, learning under me. My private group is phenomenal for investors at all stages because, of course, curriculums can get you up to much higher stages very quickly, right? These are things that you can learn over the next 10 years, or you can learn them over the next 10 days and 10 weeks by going through those courses. It's up for you. You can choose to learn them over the next 10 years the hard way, or you can choose to learn these things over the next 10 days, 10 weeks, depending upon how fast you're able to go through all those course curriculums, right? And save yourself 10 years of headaches and, all that crap, right? Plus get access to the best software you're going to find out there in the stock market, which is 1000xstocks.com. So, and then once again, we'll send you your Steel membership cards to your house. So hope you guys enjoy that. Pinned comment down there. Much love and have a great day.